So whether we'll see Aegeus come back and make another bid for Direct Line is going to be of interest to investors. What impact, as Joe was saying, does it have on Aviva's return of cash to shareholders? Remy Cointreau disappointing with its numbers, and we're watching to see the latest news flow around Royal Mail. As Joe was saying, that could be of interest with regards to the Czech billionaire Daniel Kretinsky.
Let's take a look at this market open then. Thanksgiving Day in America. Low volumes likely, certainly as the session progresses. But let's see how we're getting going here in Europe, at least this morning. Maybe a little rear-view mirror stuff being priced into the market. The FTSE 100 is up by 0.1%. It'll be interesting to see how quickly everything else gets going this morning, given the fact that we aren't expecting a big volume day. The stock 600 is up by 0.3%. We'll wait and see what happens with the CAC this morning. I think the CAC's probably the focus of our attention. Big moves yesterday, particularly in the banking sector. This morning we see Greece and French bonds trading at parity, which is a fascinating development. The CAC is, though, up by 0.4%. Remy's in the mix there as well. The DAX getting going a little early, up by 0.5%. So a little positive start for Europe this morning as we think about Christmas and the fact that it is coming post-Thanksgiving, Kriti.
Did you really just say that? Oh my gosh, guys on the Christmas train. I'm thrilled. We'll get there. We'll get there. When you look at the stock market open this morning, you are seeing that optimism, to your point. A lot of that feels to be tech-driven. Your biggest index contributor to the upside on the stock 600 is ASML, and that really speaks to that story that Guy and Anna were referencing earlier in the show around applied materials, the kind of bump that maybe some of these Japanese makers can get as well. That's certainly feeding into the European session. But some of the underperformers of the last couple of days also reversing. But again, it is a light liquidity, light volume kind of day, as Guy was pointing out, Anna.
Yeah, absolutely. Worth lingering on that move on ASML. 4.5% higher then for the chip equipment manufacturer. And this in the face of difficulties that US chip equipment manufacturers are going to face in supplying high-tech AI chip manufacture to China. And so that sent, as you say, Kriti, the Japanese competitors higher. It's now sending ASML higher. And I think maybe you get this sense that as we come towards the tail end of the Biden administration, there's even less chance that the Dutch and other allies are going to go along with these measures against China, perhaps keeping their powder dry, waiting to see what Trump delivers. And if they've got then cards to play on this front, choosing to wait and play them later. So ASML in the meantime looks strong.
It's interesting because there was a sense, I read the story first thing this morning, and my sense was that this could have been worse.
Yeah.
That the Biden administration could have gone further. And I'm surprised, given that if that was the sentiment, you would have thought that would have been priced in. That there would have been some anticipation that maybe AMAT would have suffered.
The market not reading the original news flow, perhaps. Yeah,
maybe.
Just responding to this as if it's the first time we've seen it.
Yeah, well, the theme here, right, is that there is a chip glut that a lot of these chip makers are going into. So when you remove or put restrictions on some, it just opens up market share for others, and perhaps that's the read-through as well. In the meantime, I should mention we are also getting headlines on the macro front out of Spain. Their preliminary November hard money CPI numbers coming in bang in line with estimates at about 2.4%. The estimate there was 2.4%. But in an environment where we're talking about which debt on the periphery outperforms, this is a relevant number to keep an eye on. Let's marry it all together. Joining us around the table, Benedict Lowe, equity and derivative strategist for Europe over at BNP Paribas Markets 360. Now, I'm not going to ask you about Spanish CPI, but I think it is relevant in how you trade some of this equity story in Europe. What is actually driving these markets? The stock market, I should be more specific. Is it still the inflation narrative? Is it ECB cuts? Is it the Trump overhang? Or is it the political situation? What is driving, do you think, the stock 600?
I would say since the end of September, there's been the massive pricing of a Trump trade, with Trump, first of all, that was rising in the poll, and then his election. And really, we've seen a massive underperformance of the Euro stocks versus the S&P over that period. That brings the year-to-date underperformance of 5V over S&P of 20%. That is very, very massive. So really being driven by sentiment mostly. So we've seen that earnings were not great. We still have weak macro. So the background is not really positive at the moment in Europe, but it's been really a sentiment that has been driven this really massive underperformance versus the S&P.
So what does it take to make Europe attractive again? What does it take in terms of valuations or pricing or even buyback strategy that maybe attracts a little bit more of that international capital?
Yeah. So when we look at our positioning, which is the US versus European positioning indicator, we've seen that the divergence between the two is at the max level that we've seen over that period since 2017. The last time it was at those levels, there was 2 times. It was before 2018, the Volmageddon episode where we had massive inflow into US equity, and the second one was during the Russia-Ukraine war episode in 2022. So really, really stretched levels. So that means that we can have a squeeze higher because basically Europe is unowned, unloved, meaning there's very low positioning in those regions that can lead to a squeeze higher into year end. Other story next year means there's a lot of negative news already in the price around the tariff, so we can have Europe that performs on the back of that. Maybe a peace deal on geopolitical conflict between Ukraine or Russia, and also the rate story that is a really important one. The Eurozone is really dependent on rates, it's very sensitive to the rate cycle, so if we have lower rates with the ECB, that can benefit more the Eurozone than elsewhere, basically.
Just to simplify this, so I buy puts on US stocks and calls on the rest of the world.
Yeah, I mean, it would have been a tricky one to hold, but one of the position that looks quite good is put on S&P or versus put on another index, because that has been the really big underperformer.
The relative trade of the 2 puts is maybe the way to go to keep to preserve.
And you
capital.
get that. Yeah, there's more like there's a premium on European vol at the moment, and meaning that you are selling that put with a more decent like kind of vol premium. So you're getting an interesting vol premium on that one. Yeah.
In terms of what we've seen this year has just been Europe's been cheap for a while. What changes to get the market going? You just gave me a whole load of lists of things that could change. Are they big enough? Can they change the narrative? Because I've been hearing this story for a while. Europe's been cheap all year. Europe's been cheap for ages. The valuations get more and more stretched. What actually needs to change in terms of US investor sentiment towards Europe to get that shift in mentality? Because that feels like it's what needs to happen here. I think it was a piece in the Journal this morning as I was coming in reading it, talking about the underperformance of people's portfolios in the States because they've got this kind of 25% slice of European equities in their target plan pension funds, in their 401ks, and those are the headlines that people are reading in the States.
Yeah. So a few things. First of all, that is definitely a contrarian view. I think the US long has been really a consensus trade. But one thing has been that we looked at what happened usually when we got this massive level of underperformance. This has happened only 9 times since 2000. Yep. And what happens a year after that is usually European stocks tend to perform well. They tend to rise 9 to 10% a year after that. Now, the key thing is they don't necessarily outperform the S&P, so maybe that's not really the trade that you should be pushing for, but they tend to go up. So it doesn't mean because we had a kind of difficult year, we had geopolitical issues, we had also political issues, and we're going to get another election into next year. But that doesn't mean that European stocks don't perform down the line, maybe not outperformance versus S&P, but still good performance for next year.
Okay. Benedict, talk to us about volatility. It seems as if we say a lot, the only thing that's certain is volatility. But actually, reading your notes, you put 2024 in perspective, and actually, was it not as volatile as it felt? Talk to us about the sort of what you actually see on volatility markets during 2024 before we look ahead to next year.
So 2024 has been a year where there's been some pockets of volatility. So we had the French election episode at the start of the summer.
And I remember August.
Exactly, the August massive sell-off, exactly, with the VIX going to 60. So we had those two episodes, and then we had the US election, and we saw that vol was floored around that episode. We saw like vol repricing higher, because basically that was the main event of the year. People were taking some chip off the table. There was some uncertainty around who's going to win, and what you tend to see, there's this cyclical pattern where volatility tends to go up. Now, post that, we had a vol crash in the US. This didn't happen to the same extent in Europe because we had First of all, this massive spot on the performance, but also because we had the resurgence of geopolitical risk. Now we say going into the next year, we've got a decent vol premium versus the US, around 2 vols. And also we've got the fact that vol is actually not really realizing. When you look at the 10-day realized vol on 5E, it's at 11, you're paying 15 on 3 months. So you're really seeing that premium, and people will start to harvest it once, because it becomes just so tricky to carry.
And what does that tell us about Trump and the level of volatility he introduces into markets? Obviously, we can look back at the first, his first period in the White House, and maybe that is or is not useful this time around. Was he volatile then? Will he be more or less volatile now?
Yeah, so when you look at 2017, that was the first year that Trump came in, that was the lowest ever realized vol for S&P, and second lowest ever realized vol for 5E. So Trump didn't equate to higher or excess vol into the market. Now in 2018, we had 2 episodes of higher vol. That was Volmageddon, but that was driven by kind of massive short vol positioning. And we had the sell-off at the end of the year, but again driven by more US rhetoric in Europe. The realized vol were also quite low in 2018. And when we look at the analysis of whenever Trump was going to the media and saying he was going to put some tariff on Europe and China, we didn't see excess vol at those levels. So really this was pointing more to spot on the performance or spot reaction, more so than vol market reactions.
All right. Benedict Lowe, equity and derivative strategist for Europe over at BNP Paribas Markets 360. We thank you so much. She's talking a lot about that concentration story, Guy, when we're talking about things like the heavyweights, the Core 6.
Let's take a look at what that Core 6 looks like this morning and figure out exactly what is going on at the centre of Europe. This is the picture. We are seeing some interesting moves when it comes to some of the tech stocks. Take a look at what is happening with ASML. Is up aggressively on this Biden move when it comes to chips and China. Elsewhere, more muted moves, I would argue. Schneider is up. Nestlé's unchanged. Novo Nordisk moving a little bit. We'll talk about Ferrari a little bit later on, and whether or not actually higher tariffs could ultimately higher prices, which might actually boost the brand's appeal. We'll talk about that a little bit later. Joe Easton's here with more details on the single stock moves.
So we have got a massive jump today in direct line shares, Guy. This one rising around 35% at the moment, but still trading actually below the implied offer price from Aviva, potentially reflecting the fact that Direct Line said that this undervalues the company and therefore they are not engaging with it currently. But we're seeing Aviva's shares coming down, potentially reflecting that they have got a buyback at the moment, and analysts asking whether this is in question. Aegeus or Aegeus was the previous bidder for that one, looking steady. Admiral, meanwhile, the big rival, is gaining potentially a bit of a read across, but a huge gain for Direct Line following that big bid from Aviva, the biggest bid in insurance we've had for a while. Then in terms of other M&A, there's lots going on in the UK today. Take a look at Loungers. This is the owner of Cozy Club. There's one in my hometown, Guildford. I love that place, Cozy Club. Loungers getting a takeover bid. My mum loves it as well. And they're up 29% at the moment from that bid. IDS, meanwhile, now this is the Royal Mail owner, of course, the Czech billionaire Daniel Krasinski, moving forward with this takeover bid. According to the BBC, now the bid was at 370. We're still only at 360 in terms of that takeover price there. And finally, down the bottom there, TI Fluid, another bid coming in, around £1 billion for the maker of hydraulic brakes for that. There's lots going on in the UK. In terms of the drink stocks, though, pretty steady at the open there. Well, actually coming down 1% now for Remy Cointreau. Another downgrade sales guidance, but the stock down 70% over the past 3 years. So potentially a lot of this priced in, but still seeing a little bit of a dip. That is potentially surprising given how much it's sold off. But as I say, the numbers worse than expected on that one. And then in terms of chips, that news about the potential US rules on those potentially not being as harsh as some expected in terms of between the China and US, the chip supply there. And as such, we're seeing a decent gain. Guy mentioned earlier ASML, but we're also seeing ASMI and VAT Group coming up. BE Semi, a pretty decent move in those chip stocks today. In terms of morning calls, Tesco, a double upgrade, and so is Sainsbury's. This is at JP Morgan that says the thesis of declining food inflation has actually played out now. So they upgrade both of the big UK supermarkets. Tesco up 2% there. And then finally, Telecom Italia. This one is upgraded over at Exane. They say that telcos is a way to play the macro and political uncertainty. They like telcos in general. They upgrade Telecom Italia. That one's marginally higher in Milan today.
Joe, thank you. Joe Easton with an update on your movers. Yeah, technology stocks doing really well today. They're up by 1.8%, really lifted by that move in ASML. We will get to that story shortly. The US is said to be readying more curbs on sales of semiconductor equipment and AI memory chips to China. That seems to be moving Japanese tech stocks, European tech stocks. We will get all the details next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
$16, 17 minutes past the opening trade. This is what equity markets look like here in Europe this morning. Tech is on the front foot. ASML certainly seems to be a big beneficiary of what the Biden administration is up to, because it's said to be weighing additional curbs on chip sales to China, a crackdown that some say stops short of some of the stricter measures that had been previously considered. Let's talk about this. Katya Dmitrieva joins us now to talk about what is going on and why the Biden administration is doing this. Let's talk about why now. Clearly, this is an administration that is coming to its close. What is the Biden administration trying to do in the final days of office?
Well, I think that's exactly it. You know, the Biden administration has limited time now, about, 8-9 weeks, give or take, to kind of move through the policies that they had promised before. So officials had been discussing, specifically to do with chips, these additional curbs. And this news that we have, which is a scoop from our colleague Mackenzie in D.C., really highlights and gives market watchers some very much needed information, because previously there were so many questions about what countries this would involve, how many companies would be targeted. And it looks like the final results, or what's currently being discussed, is a lot smaller, or significantly stepped down from what policymakers and some in the markets had expected. So I think that's why we saw Japanese stocks, in fact, moving up after the news came up, and also some Chinese stocks as well, some Chinese companies rather, that were previously thought to be on the initial list didn't actually end up making it on. Of course, we don't have the final statement from Biden or officials. That could be coming kind of as soon as next week. But it's the TLDR of it is that it's significantly stepped down or smaller from what folks had expected.
Okay, that's interesting, and the way the market's responded is certainly interesting, Katia. Where does this leave then China-US relations in the final weeks of the Biden administration? A reminder that this administration perhaps is not done and is still active on this chips front.
Yeah, it's really interesting, actually, because in recent days and weeks, U.S. and Chinese officials have been really stressing areas of common ground. So, for example, after Trump announced, tariffs, he's been doing that all on the campaign trail. Biden officials were really keen to underscore areas where China and the U.S. have actually made headway. So specifically on issues of fentanyl, for example, that was a key piece of what Biden has done with Xi and other officials, is to sort of keep fentanyl off the streets in the U.S. and stop those precursor chemicals from coming in. So that's kind of been an interesting dynamic, especially when you have a presidential candidate coming in, President-elect Trump, who's kind of taken a different route. So, this is sort of the last few weeks where these policies could be made, and really potentially not surprising and smaller in the scale of things to come.
Yeah, Katya Dmitrieva walking us through all the angles around these chip curbs out of the United States and the ripple effects on the rest of the world. We thank you so much, of course, for bringing us that crucial context. She talked about it. The change in administration may be creating some pretty big moves. That's a similar theme in the antitrust space. The U.S. FTC launching a broad investigation into tech giant Microsoft, looking into everything from cloud computing to AI, even to cybersecurity ahead of that transition. Let's get a little bit more insight. Bloomberg Executive Editor for Global Technology, Peter Elstrom, joins us right here. All right, so we're no stranger to the FTC going tough on big tech. Well, what exactly are they looking into for this case?
Yeah, in this case, as you mentioned, the Biden administration is trying to get some of these policies through in the last weeks that they have in the term. With the FTC in particular, Lina Khan has gone after these big tech companies very aggressively. At this point, she's concerned about how the Microsoft is wrapping together the cybersecurity technology that they have, cloud computing, AI, some of these different services together. And there's some concerns that they're using that market power to be able to retain their position and keep out some of their competitors. There also may be some risks for customers, including the federal government here, because they're buying so many of these services from Microsoft. They may be vulnerable in a way that they wouldn't be if all these services were not wrapped together.
What is the Trump administration going to do with this? Because this will spill into the Trump administration. There had been this expectation that with Lina Khan gone, things were going to get easier. Is that really going to be the case?
Well, that's the big question here. We saw with the export curbs, the Biden administration is able to get those things through pretty quickly. They can issue these executive orders. They can actually move ahead with these things. An antitrust case does not work that way. It takes years and years. Yeah. We saw that in the last investigation into Microsoft that dragged out for many, many years. So certainly Lina Khan and the FTC are not going to be able to finish this during this term. The question is what the Trump administration is going to do as they pick it up. In general, there's an anticipation that the Trump administration is going to be lighter in terms of regulation, probably lighter on the big tech companies. But there have been a few dissenting voices, including J.D. Vance, the vice president-elect, who's been quite critical of the big tech companies, is quite concerned about what could happen here. So we still have to see those steps. But at this point, Lina Khan is putting her cards on the table. We're going to see exactly how aggressively they're going after Microsoft in this case, and maybe some of the other big tech companies.
I'll finish off with a question on Microsoft, but maybe we'll circle back to some of that because that's really interesting, Peter. How does this compare to the last antitrust probe then on Microsoft? Because we've sort of been here before, what, a quarter century ago?
That's going back quite a while, right. And in the U.S., of course, the FTC and the Justice Department have historically launched these antitrust investigations. Last time it was the Justice Department that was really leading it. They were particularly concerned about how Microsoft was using its operating system, the Windows operating system, to wrap in all sorts of other services with it. At that time, the web browser, they were competing with Netscape. That was kind of a concern. Now we have a much broader range of products. Microsoft, it was powerful then. It's even more powerful now. At that point, there was a decision that Microsoft was a monopoly. It was abusing that kind of power. But it got overturned in the appeals court, and they weren't able to proceed with this breakup that they planned. At this point, they're more powerful, but also they still have to figure out whether they're going to be able to break apart some of these products.
That's what I was going to ask next, because you mentioned the DOJ as well. They're already trying to kind of suggest to a federal judge in the United States, Amit Mehta, I believe, who's ruled on it, of a Google breakup. And that, I'm curious what kind of remedies actually are tangible and feasible. And we hear it so much from Washington, but from lawyers, from the pros on the tech side, what is an actual feasible concession, a feasible remedy in terms of how these tech companies can operate?
Yeah, well, we're much earlier in the process with Microsoft in particular. It's not clear how they could divide up some of these businesses. I think the cloud computing business is of particular concern now because they feed into all sorts of other services that they offer, including AI, cybersecurity. Microsoft, of course, has this alliance with OpenAI, which has given it kind of a pole position in some of these AI services. I think for Google, they've laid out that they do think it's possible to break out the Chrome browser in particular, and maybe that's a feasible separation. They haven't really articulated how they would address some of these Microsoft concerns on the antitrust front.
And you mentioned earlier, Peter, that the Trump administration, I think you said the expectation is they maybe go a little lighter on some of this regulatory push, and that might seem sensible at a holistic level. I wonder what kind of wild card Elon Musk is in the mix when it comes to thinking about tech and how the new administration handles tech, because he's got so many views on all of this.
So many views, and he has competitors, he has allies. Of course, he has his own AI venture that competes with OpenAI. He has a history with OpenAI, too. It's not exactly clear how he's going to play a role in this, but certainly he has the president's ear right now. He's going to have the president's ear going forward, too.
I mean, Zuckerberg had dinner with the president at Mar-a-Lago yesterday. I guess all these tech leaders just trying to get ahead of the administration and say their piece. Not staying for Thanksgiving, though, that his spokespeople were keen to point out.
They certainly want to build relationships with the new administration. They've seen that some of the tech industry already has done that. Elon Musk is probably the prominent one, but there are some others that have not done that kind of work so far, so they want to make sure to build the relationships going into next year, going into the new Republican administration that takes office in January.
Okay, Peter, thank you very much. Thanks for joining us. Bloomberg Executive Editor for Global Technology, Peter Elstrom, with us on set this morning. Chrissy?
Of course, as we monitor the ripple effects of that tech story, we should also keep an eye on the other story we're focusing on, that is France. As we were speaking with Peter there, French bonds catching a bid, down about 5 basis points on the 10-year as well. I don't really know what to make of that, to be completely honest.
France is not Greece. France. So the finance minister's been on French radio.
Yeah.
Are people listening? Maybe that is the case.
Well, he's apparently saying that he's ready to make concessions.
That's it.
Is that what they're responding to?
That's the line, yes. The question is whether it's better to have a budget that is not exactly the one we want or no budget. And that seems to be where the French have got to. So are we going to see a revision to this budget coming through that will then be able to be passed, acceptable to Le Pen and her party? And that might mean less chance that the government collapses.
She's taken herself quite a long way down this road already. The concessions seem to would maybe have to be substantial in order to get her back on side. That must be the challenge at this point.
You know, we see this bond volatility and we see the stock market volatility, but these headlines don't move the euro. And I'm so conscious of why there's that kind of disconnect between you're seeing this volatility in the spread, but it's not being reflected in euro dollar. Something to be talking about as the days and the weeks ahead. Euro dollar 105.33 at the moment. Coming up, we're going to dive into one of the major French companies making headlines this morning. Rémy Cointreau moving quite a bit this morning. Stick with us. This is Bloomberg.
in case you missed it on Bloomberg Technology.
We're excited to really change the expectations for space companies, where you have this always-on, reliable, and frankly dynamic satellite connectivity that you would expect of your power grid or of your cell phones. And so we think that this is a huge opportunity space, and our first contribution to it is through shared infrastructure.
You can see this whole ecosystem developing, and you have an exponential growth right now because easier access to space means more demand for space, and that's the definition of an exponential growth function. So if you think about someone like Varda, who is only possible now because access to space is cheaper and easier, we're demanding more access to space.
I think that's what's so exciting from a business perspective, the fact that if you can do it, you're one of a few numbers of organizations in the history who've actually pulled it off. And so it creates a very defensible position because, again, space is very, very hard.
Don't miss Bloomberg Technology live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
This is the opening trade. We're at 30 minutes into today's session. Seeing green across the screen, a lot of that boosted by the tech story as well. We were just debating whether or not that is a positive in terms of some of these chip curbs for the equipment makers, or perhaps a little bit of a read-through of the positivity from Asia. Regardless, you are seeing green on screen. It is Thanksgiving in the States, which means light volume, light liquidity. So there's that element of a little bit of autopilot as well. Let's get to one of our top corporate stories in Europe that we're keeping an eye on. Remy Cointreau has forecasted a larger than expected drop in annual sales, saying he doesn't expect a recovery in U.S. markets until at least the end of the year. Following this closely is Bloomberg's Saba Meddings joining us around the table. Saba, we're watching the stock drop about 1.2%. Walk us through the sales story. Why has it taken so long to recover in the States?
I think we have to compare it to what happened during the pandemic when everyone was at home. They were making cocktails, they were drinking, they were really sort of splashing out. So what you saw then was retailers and wholesalers stocked up. They made sure there was plenty of people to buy. And obviously, as that has trailed off, and then we've also seen a consumer slowdown in spending, these wholesalers have got extra stock that they haven't been able to shift. And so that's meant that Remy has taken longer to recover in the US. We're comparing to what happened during the pandemic, and they were quite optimistic this time last year that it would sort of recover quite quickly. But each time they've reported quarterly results, they've sort of had to say, actually, do you know what? It's taking much longer than we expected for those inventories to push through the.
So they need people to drink through those inventories. Basically, that's the message on that front on the US.
Exactly.
Thinking about the US, tariffs very much front and centre. Have they given any guidance about what they think the potential impact might be of another Trump administration imposing tariffs on, for example, French drinks companies?
Well, I mean, for Remy, which imports 100% of its stock into the US, there's no manufacturing there. It's going to have, obviously, a big impact if you think about all the product coming to the US. We did ask about that on the call this morning with the CEO. He said that, if this mooted 10% tariff comes in, that's not going to kill the business. But obviously, they haven't been as aggressive with pricing as their competitors, so they sort of have kept prices at the higher end, which means they don't have as much flexibility in reducing prices to keep sales up for customers. So I think they are more worried about China, but certainly it's something we'll definitely have to watch.
There's another way of looking at this, which is basically that the inventories that they've got in the States have already been imported, so there's not going to be any tariffs. So in some ways, that could actually turn out to be a little bit of an advantage going forward from here if tariffs are imposed. You mentioned China. How big an impact are the tariffs there?
Well, I mean, for China, volume-wise, it's the second biggest market after the US, but profitability is the most profitable market for these cognac makers, for Remy, for Pernod, for the others. They've already started having to sort of make deposits for these tariffs, sort of average of 35%. So it is having a huge impact. You can see that in the share prices. Remy down 45% this year. They're not going to bottle in China, though. They've said that because obviously Hennessy had some issues with workers. They were talking about maybe bottling in China to get around the tariffs, but Remy has ruled that out.
Okay. Tariffs front and centre. Saba Meddings, thank you very much indeed. Joining us now, Sweta Ramachandran, Fund Manager at Artemis, where she oversees their leading consumer brands strategy. Sweta, what do you make of the Remy numbers this morning? What's your take, and how should we be applying what we know, don't know, on the tariff story to this stock?
I think in a sense, the story for the entire spirits sector is one that Saba succinctly summarized, a story of too much inventory that needs to work its way through the market. And I think this is confounded also by the price increases that many of these companies have taken in the last few years to not just combat but more than offset inflation. With consumers' disposable income stretched, that has come at the expense of top-line momentum, which is what we're now seeing. And in addition, consumers are trading down. So we're seeing that higher-priced variants of alcohol are losing out to lower-priced variants, which of course has a big margin implication for many of these companies, given that they make most of their money on the higher-priced variants. So a lot of factors going into play here, but if we look at the share price reaction of Remy just this morning, for what is a 15 to 16% downgrade to earnings estimates, the stock is down significantly less than that, which suggests that a lot of the bad news is starting to be priced in, and perhaps investors are starting to look past the current cyclical trough for the next upswing, given that this is most likely a cyclical downturn rather than a structural one. Indeed, management has already alluded to some green shoots that they're seeing in U.S. depletions, if not in inventories. So a lot to unpack there.
What's in the price for tariffs, though? Are we assuming that tariffs are going to be applied? This looks like an obvious target. Is that already in, or is that yet to be applied?
I think the sentiment and news flow around tariffs is far more damaging to the near-term share price performance than the actual reality. If we look back to Trump term 1 in 2017 to 2020, similar proposals were raised. At the end, all were watered down except for tariffs on imported single malt Scotch, as well as Irish whiskey that's made in the UK but not in the Republic of Ireland. So significant clawback from the initial proposals. Again, we don't know what the outcome would be and whether this is, for instance, as the Treasury Secretary, before being appointed Treasury Secretary, called them a maximalist position and a negotiating starting point, or the ultimate reality. But it's true that Remy, with its focus on maintaining price integrity, has not participated in competition in the US, so its ability to pass through higher prices may be more limited than some of its peers.
Sweta, you were talking about whiskey there. I kind of want to talk about tequila. You and I have talked about where to find the perfect margarita in London quite a bit. But for the Mexican tequila that gets imported here, how much of the pain is perhaps exaggerated or magnified relative to the examples that you just laid out?
So certainly Diageo and Campari are two of the biggest in the spirits industries, the biggest tequila importers into the U.S. They would need to then take price increases of roughly mid-single-digit percentage points in order to offset the 25% tariffs that President-elect Trump has proposed. The thing to note here is that U.S., Canada, and Mexico are covered by the USMCA at the moment, a free trade agreement which has supplanted NAFTA, which itself was the creation of the former Trump administration. So to undo all of that and impose these additional tariffs, whether they are actually passed through is still a question mark. And then you have a partial offset in terms of Mexican peso weakening. So that may, in some ways, dampen the required price impact, that price increases that are required as the exports become cheaper into the U.S.
So my margarita may or may not get a little bit more expensive. Sweta, talk to us about the retaliatory ability on the European side, or even on the Mexican side as well. We talk a lot about U.S. imposing these tariffs. Is there kind of room for retaliatory measures in this space?
Certainly, I think the EU's hand perhaps is a little bit more stretched in this regard, given that they are also engaged, at least on the consumer side, in a separate tariff war with China, where, again, the Chinese authorities have targeted French cognac somewhat symbolically in retaliation for the EU investigation into Chinese EV subsidies. And that's underway at the moment, as Saba mentioned, with dumping duties already provisionally imposed of up to 35%. Some manufacturers talking about bottling in China to get away from this. So really, it's kind of tariff everywhere. But it does seem that the EU's ability, being caught in the crosshairs between China on the one hand and the US on the other hand, is more limited than other geographies.
And Spencer, picking up on that China theme and the dumping duties that have been alleged by China and appealed, I think, by many in the Eurozone. We heard a bit about that from Remy today, but they really seem to be downplaying it almost, suggesting that this wasn't having too much of a material impact. Is that what we've learnt so far from this particular iteration of the tariff story?
So the issue in China with regard to tariffs is that it's not making a difference at the moment because demand is so weak generally. And the variants of cognac that are working in China at the moment are the lower price variants rather than the XO and higher, more expensive variants of cognac that were all the rage just 5 years ago. So that's really why it's not having so much of an impact, because underlying demand is so depressed. When that starts to come back, that's really when we'll be able to get a truer gauge of consumer elasticity and whether that downtrading phenomenon continues because consumers are simply not able to stomach the higher prices. It's possible that in China, because the higher priced variants were sold to a particular group of customers who are simply away at the moment because of business confidence, that the ability to pass through prices there is not going to be as much of an ask as perhaps in the US, where it's the more entry level and mid-priced variants that are the bulk of the market.
We're heading into into Black Friday, Sweta, and we're heading into the holidays. Give us your assessment of the US consumer mood. I think you're expecting a sort of decent holiday spending period. How does that sit with some of the downtrading and destocking that you've been talking about?
Yeah, I think the broader kind of spending environment, the consumer environment, is quite buoyant. For example, we've seen significant consumer resilience in the U.S. as inflation has started to moderate. The National Retail Federation, which is really kind of propaganda for the retail industry in the U.S., projects record high spending per capita on holiday expenditure. Of course, that's a function of higher prices. But even so, it doesn't seem that the consumer is in a significantly worse state. There's some green shoots emerging. For example, Macy's suggesting that sales, especially of luxury in the U.S., are recovering. Some of the luxury companies calling a little bit of a turn in the U.S., which has been very weak for them after having been a phenomenal market for much of the post-pandemic era. Some green shoots are starting to emerge, possibly need this to sustain. And again, the big question is how much of this will be dampened perhaps by potentially higher tariffs and inflation into next year. But at least into year end, the mood music led by record high equities, Bitcoin, as well as house prices at record highs, is supportive for consumer spending.
Sweta, which stock should we think of being price insensitive? If prices go higher, consumers will continue to buy. Is it Hermes? Is it Ferrari? These are kind of the names, the obvious names, where actually tariffs aren't going to have an impact, in fact, could have the opposite effect.
Yeah, I'd be looking for companies which really cater to a very inelastic consumer segment, where the impact of a 10% higher price is not going to dissuade that consumer from purchasing that product. Ferrari certainly in that category. Even Ferrari at its quarterly conference call was somewhat circumspect about passing through price increases should tariffs be imposed. I suspect that's more of a customer goodwill gesture at this stage, and in reality, that company, more than perhaps any other in the consumer segment, has the ability to pass on higher prices because of its long wait lists and order books. Similarly, companies like Brunello Cucinelli, Hermes have that ability as well. I'd also put into this category companies that did not exploit pricing as a lever to drive growth in the last few years, because many companies in the luxury segment took the easy way out, increased prices by a lot. We all know the example of a Chanel bag that's today 60 to 70% higher for the same product than it was 3 to 4 years ago. And I think those companies will find it harder to put through incremental price increases when there's no incremental value being added.
I know, those price rises really hurt. Sweta, great to see you. Thanks very much indeed. Always fantastic to get your take on what is happening here. Sweta Ramachandran, fund manager at Artemis. What are we going to talk about next? OPEC Plus delaying a meeting that was scheduled for this weekend, with producers seemingly kicking the can down the road on supply decisions. We're going to talk about that next. This is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back to the opening trade. 45 minutes into a session that no doubt will be a little quieter than usual. It is Thanksgiving. Happy Thanksgiving if you're in the US, or if you're American and find yourself elsewhere. We have European stocks, though, making some gains in the meantime. Is this in sympathy with US tech, or is this in response to the US tech news? Certainly it's to do with chips, and it's to do with curbs being imposed on US tech names by the Biden administration. So we're keeping an eye on that sector. We're also watching what's going on with oil. It's been a busy time geopolitically, and oil prices have been responding in recent sessions. But let's talk about something else when it comes to oil. OPEC Plus has confirmed that Bloomberg's, the earlier Bloomberg story, that it has that it's delaying its meeting on oil production curbs to December the 5th. The discussions had originally been scheduled to start on Sunday, just this coming weekend. So let's get to Bloomberg's Middle East energy markets reporter, Anthony DePaola, who's with us this morning. Anthony, what can we read into this delay then, do you think?
Good morning, Anna, and yes, happy Thanksgiving. Yeah, it's a delay of this meeting, supposed to take place over the weekend on Sunday, delayed now to December 5th. OPEC Plus, OPEC itself is saying that this is delayed because some ministers will be attending a GCC meeting in Kuwait. course, those kind of summits are planned well in advance, as was this OPEC Plus meeting. But really what we've seen is some diplomacy behind the scenes in the OPEC Plus group taking place over these last couple days. Bloomberg has reported that some of the members have already started discussing delaying that plan, and the idea is to delay the return of some of those barrels into next year, potentially even for more than just a month. So they've already delayed the return of some of those barrels a few times, and they're looking to do that again, simply because the market just isn't ready for those barrels. Plus, we've seen some trips by the Saudi energy minister and the Russian energy minister to some of the OPEC Plus allies. They were in Baghdad earlier this week, speaking with the Iraqi prime minister, and they had a call with the Kazakhs just yesterday. So these are some of the countries that have been known as the cheaters in the group, those that are producing over their quota. That issue with non-compliance with the quota is one of those things that OPEC Plus, particularly the Saudis, see as a negative, something that's weighting down the price, putting more oil in there. Of course, the Saudis are some of the biggest cutters. They want to get their oil back in there and not forgive it. An interesting thing as well, December 1st, December 2nd is the UAE National Day. The UAE is another one of those countries that has been said to be producing over quota as well. So we haven't seen a visit there yet, but potentially the UAE minister didn't want to travel a day before his National Day because there's a lot of events going on here. I'm in Dubai right now, and there are flags everywhere and lots of events for that National Day. So those are some of the issues. I think it's probably more that behind-the-scenes negotiation and those behind-the-scenes talks that OPEC thought they needed some more time. That's why we pushed this meeting. They pushed this meeting back to December 5th, Anna.
Anthony, does the world need more barrels of oil right now?
Yeah, Guy, well, that's what they are struggling with, and the answer is no. There is already some lot of length in the oil market, some oversupply, and if we look forward to 2025, which is what the OPEC Plus group is doing, they are seeing a lot of oversupply as demand comes in weaker than a lot of people had expected. And what we see is a lot of other oil coming from other countries outside of OPEC Plus. That is like the United States, like Brazil, like Guyana, Canada, for example. Those countries will continue putting barrels in the market, and the amount that's expected to come on from those countries outweighs the amount of demand growth that we're expecting to see next year. So that doesn't leave any room for OPEC Plus to bring oil barrels back into the market. And so that's really the conundrum that they're struggling with. They have got these more than 2 million barrels off the market that they want to bring back on. They're foregoing market share. The price is hovering now between 70, 75, which isn't terrible, but not what they want from their point of view. So they want to get that oil back on the market, but they don't want to forego a higher price. So they're really struggling with what amount of oil do we want to put on the market and at what price. So that's really the issue. And the short answer to your question, Guy, is no, they don't need that oil right now.
Anthony DiPaolo walking us through the oil story, of course, as OPEC delays that meeting to about a week from today. We thank you so much for walking us through it. He's talking about the supply story, of course, some of that really kind of buffered and cushioned by the U.S. shale story as well. But on the other hand, you have the geopolitics in the region on both the war in Ukraine and the war between Israel and Hamas as well, both that could have the potential to move the oil story. I want to stick with that theme of defense and the geopolitics and, of course, the war zones in this part of the world. Countries in the Nordic region have long been among the most vocal about the threat of war on their doorstep. Now, Finland has set up a website showing people how to last 72 hours in the event of a crisis or conflict. And people in Sweden have been sent leaflets on preparing for war. Let's get more from Bloomberg's Nordic managing editor, Kati Poyanpalo, joining us this morning. Kati, why now?
Hi. So Russia's war in Ukraine has really brought it home to a lot of governments in Europe that war is not something that's in history books. It can happen here as well. And given the primary job of a government is to keep its people safe, they're wanting to prepare now. But war isn't the only scenario they're looking at. We've just been through a pandemic a few years ago globally. There's climate change bringing extreme weather events such as the recent floods in Spain. And we also saw an energy crisis 2 years ago. So there's a lot of different threats that governments want to be preparing for right now.
Yes, indeed. And we've seen the region where you are, Cathy, we've seen a lot of re-evaluation of being members of NATO. And so this plays out at the geopolitical level. But on the ground, what's happening in the different countries, in particular in the region where you are, in terms of this preparedness?
So there's a lot going on. As we mentioned, Sweden sent leaflets last week to 5.2 million households in the country, all of them, giving them just basic information on what to do in various types of crises. Finland last week launched a website that includes all of these instructions. Lithuania is making way in stockpiling medicines as part of this bigger EU project to have 22 stockpiles of essential medications in 16 member nations. And in Denmark, for example, the financial sector is being prepared. They're looking at a scenario where if power went out for a week, how could you pay for your groceries? And they've come up with the system where your debit cards would still continue to work, with the financial system and the retailers kind of taking the risk half-half. And then you've got places like Norway and Sweden as well, who are thinking about restarting grain stockpiling. A lot of countries never stopped doing that, so a lot of countries in Europe still have those stockpiles. So a lot of efforts on various fronts.
So the question I'm sure everybody that is watching this right now is asking is, what's on the list? If we look at Finland, what are they doing? Can we learn lessons from this? Walk us through some of the key things that are being put down in terms of what you should prepare for and what you need to prepare for these events.
So that depends a little bit on whether you are a government, you represent a company, or you're a private citizen. But if we talk about what anyone can do and have in their homes, it's just basic essentials that can help you last. Even if you just get sick for 3 days and can't go to the store, it's good to have some food at home. What if, your water wasn't good? It's good to have some bottled water. There's a whole list of essential gear that Finland sort of set up on the website that you can go and check to see what you need. And one of the most common forgotten ones that people don't really think about is actually pet food. You want to be able to feed those furry animals as well.
All right, Kati Hoyanpalo, we thank you so much for walking us through it. She's, of course, the Bloomberg's Nordic managing editor. Plenty to keep an eye on in the hours ahead. We'll kick it off, of course, with, in just a couple of minutes, we are getting some of the German CPI data as well. The regional ones, the kind of overall one we get about at 1 p.m. UK time as well. And then plenty of ECB speak. Villeroy, Knott, and Lane all speaking. And of course, over in the States, the stock market is closed and the bond market is closed, but futures very much alive and well.
Are you shopping? Is that something that we should also be thinking about?
Shopping for turkeys, shopping in general, shopping online.
Or dog food, maybe.
It's a day early for shopping, isn't it? Today's the eating, tomorrow's the shopping. Isn't that the simple way to remember how this American tradition plays out?
Correct. I will be eating. I will be shopping online tomorrow. I don't know what I'll be shopping for, but I kind of have a little bit of FOMO there. You know, when there's a sale and you're like, there's a sale, I have to buy something to take advantage of the moment. I don't know if you have this.
Believe me, no.
Is this just me?
When there's a sale, I'm like, why are they selling it? Why are they selling it more cheaply? Why doesn't anybody else want it? That's kind of, precisely.
This is American consumerism that's just completely lost in the UK.
I think it's certainly lost on me. But I suspect we are going to learn some useful things over the next 24, 48 hours as to the strength of the US consumer. The latest data has been super strong. Is that going to be borne out by the reality of the numbers we're going to be seeing? You don't see people piling through stores in the way that you once did.
Sweater was giving us quite a positive take, wasn't she, on the US consumer earlier on? So even if there's a bit of a stockpile of some of those spirits still left over from the pandemic, in other areas she was talking more positively about what people are going to go spending their money on. Maybe we should just check in on bond markets before we go, because
French bond markets.
We've been watching the French story really intensely, and it does seem as if we've got a little bit more stability in that French spread just today, really. That perhaps on the back of what we've been hearing from the French finance minister about maybe rethinking on the budget. 83, the spread right now.
So we got up to Greek levels. We backed off Greek levels. Are we going to go back to Greek levels or beyond, I think is the question.
We might. That basically this volatility is coming off this radio interview that, to Anna's point, the finance minister did, saying that there may be concessions on the table. They're eager to get that budget done. Still not showing up in the euro, though. Maybe the inflation data that we're getting in a couple. It just doesn't make any sense. The euro tracks the Haute-Boon spread, so this feels like a dislocation, at least according to history. We've talked a lot about it. We're all going to gear up. We're all going to look for those Black Friday sales. It does it for the opening trade. The Pulse is up next. Stick with us. This is Bloomberg.
is Konstantin Stefana. I am the owner of the AF Family Office and the company called Company I Limited. I also have a live streaming channel for startups. It's SG Trader, so we let startups to pitch investment community on our channel. I give them 3-minute pitch. We publish their video on our channel, and everybody who is interested, please welcome to send me your video, and I will roll for almost a month your video for all financial community. The channel is live, it's streaming live 5 days a week, from morning to night.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Francine Lacqua here in Paris. France's 10-year yields match Greece for the first time ever on rising concerns about stagflation and political uncertainty. The U.S. weighs more limits on semiconductor and AI chip sales to China, but stops short of stricter measures previously considered. Plus, U.S. regulators turned their focus on Microsoft with a wide-ranging investigation into its offerings from AI to cloud computing. So good morning, everyone. There's quite a lot going on this Thursday morning. Let's take a look at the European markets map. Happy Thanksgiving for those that celebrate, especially in the U.S. We're going to have thinner volumes across the board, but quite a lot of things going on in Europe. But European stocks actually snapping 2 days of declines. Again, technology leading the advance. There is hope that U.S. curbs on chip equipment sales to China may actually prove a little bit lighter than feared. A lot of the focus is what's happening in France. We're here in Paris, where yields on benchmark French bonds actually rising amid worries that a budget standoff may topple the government. I'm looking at the rate on the 10-year French note regarded as among the safest in the euro area, actually climbing a lot. The same comparable Greek bonds, which only last year were still classified as junk. A couple of other things we're watching out for. So again, because of Thanksgiving, a reminder that trading in treasuries is actually a shot. We look at the next couple of days with quite a lot of anxiety if you're a market participant on whether the Prime Minister in France can find a way through the budget. The French 10-year yield at 2.979. Now, the Biden administration is said to be weighing additional curbs on chip sales to China, a crackdown that stops short of some of the stricter measures previously considered. Well, let's bring in Bloomberg's Katya Dmitrieva. Katya, thank you for joining us. So why are they coming now?
Well, there's a limited time for the administration to get through a lot of these policies before changing hands, of course, on January 20th, when President-elect Donald Trump will come in. And the Biden administration has really made chips one of their hallmark issues during the entire presidency. Everything from protecting local industry with tariffs and supporting local industry with the CHIPS Act and IRA. And we can probably expect a lot more of these things to come in the coming, give or take 8-9 weeks that are left, including the Commerce Department, which still needs to give out a lot of support, a lot of subsidies. That's part of the CHIPS Act, the multi-billion-dollar package. They still need to provide funding for companies. So this is just sort of the first of many announcements we'll probably hear specific to this industry.
Katya, where does this leave China-U.S. relationship in the final weeks before Trump enters the White House?
Yeah, it's a great question. What I've noticed in the past couple weeks in particular is that the Biden administration and Chinese officials have really worked to highlight places where they have common ground. And one of those issues being, of course, fentanyl and precursor chemicals coming from China, going to Mexico, making their way into the U.S. And so this sort of, if anything, serves to highlight how different the Biden administration is from the incoming Trump administration. They're both protectionist. They're both looking to do or have added tariffs onto goods. But it sort of highlights how different they are in their approach and how the Biden administration is a lot more targeted. For example, with these particular policies that could be coming as soon as next week, initially there were discussions of having about 6 Huawei suppliers, and now that's been whittled down. And there's also tariffs only on Chinese goods, as far as we know, not Japan and the Netherlands. They had been talking to Biden officials for the past few weeks on this particular issue. So it really narrows down the impact, which of course helps for business leaders and officials. But I guess I would say welcome to the next 4 years, which will be more of this.
Yeah, we'll have to figure out policies and, of course, the impact on everything from tariffs, inflation, and what the Fed does. Thank you for all of your insights, Katya Dmitrieva. Now, the Fed's preferred measure, of course, of underlying inflation accelerated in October from a year ago, supporting comments by many Fed officials that there's no need to rush interest rate cuts. Now, we're now joined by Grace Peters, Global Head of Investment Strategy at JP Morgan Private Bank. Grace, always great to speak to you. There's quite a lot of going on in terms of possible policy change in the U.S. We had quite a lot of data from the U.S. today, of course, thin volumes because of Thanksgiving, so happy Thanksgiving. But how do you see risk assets in the U.S. evolving?
Good morning, so great to be here. I mean, just referring back to the inflation print, the PCE print that you mentioned, there's no doubt that inflation risks are back on the agenda. I would say, that's flashing an amber light, not a red light to me, but we have seen signs not just in the rising 3-month trajectory of core PCE, but also with consumer inflation expectations rising. I would say, though, when we start to think, what does that mean for risk assets, that you can't take just inflation in isolation. This is about a growth inflation mix. And when we think about the growth trajectory that the next administration is going to inherit, it is very robust. We're seeing 2 to 2.5% US real GDP growth now, and that level could well continue through the next 6 months, perhaps even the balance of 2025. So we still feel the underlying US economy is pretty strong. But we have just published our 2025 outlook. We call that building on strength, because obviously we've had 2 years of strong risk asset gains, and therefore the underlying theme that we want to promote is the idea of strengthening portfolio resilience, i.e. aligning to a base case, but also managing for those tail risks that you mentioned, Francine, that include higher inflation, but also the idea that growth may weaken and will weaken at some point cyclically as we go through a business cycle.
Grace, what do we know about U.S. policy? I know, markets are quick on their feet to try and figure it out, but we still don't have, the Trump administration in place. So is the market getting a little bit ahead of itself? Could things change, or do you just expect a lot of volatility as we try and measure the impact of things that have been said?
Yes, I mean, this all feeds into the idea of what does a resilient portfolio really mean in the regime that we see today. The policies are still very unknown. We can start to guesstimate what that might mean for both that and the growth and inflation mix. And what it leads us to believe is in strengthening portfolio resilience, you want to still absolutely stay invested. As I mentioned before, we think there is a really solid outlook for growth over the next 12 months, but actually also over the medium term. But inflation risks are there. Geopolitical risks are there, risks around the deficit are definitely there, and therefore adding infrastructure, adding gold as two of our preferred ways to strengthen portfolio resilience we think is critically important. And then even when it comes to the equity book, making sure that you're broadening out your exposures, because the other underlying theme to us is capital investment, whether it be in the AI transition, whether it be in power and security needs, all of these is driving a broadening out of, we think, GDP trends, but critically also within equity markets. So go global, go broad, stay invested, but add insulation, we think, from infrastructure and gold.
Grace, do U.S. equities actually trump any other equity worldwide?
I think they still do. I mentioned that we do like to invest globally. What we're looking for there is really strong global leaders. So we don't want to bet on, the European economy, which we do think is fundamentally weaker at a headline basis, or Japan or any of the other regions. We want to just pick out really strong global companies. But we do think that US exceptionalism is likely to prevail in the period of time ahead. US earnings growth of around 11% in this year and next year, we think, with greater contribution, as I say, beyond just large cap tech. We think that's really appealing. And we would pay 21 times for that, which means that you're looking at a price target of around 6,400. So 10% upside for US equities. When that comes to European equities, we're probably looking at mid to low single digit returns with a high degree of uncertainty, as you flagged earlier, Francine, around the impact of potential policies, the timing, the magnitude of those policies. And I think even before we know, the risk premium over European assets is going to stay there. And therefore, the US is still our preferred market, whilst we like that global approach.
Grace, I'm here sitting in Paris, and actually there's a lot of concern that the government will fall, that Marine Le Pen will pull this kind of coalition over the budget. We're seeing spreads widen quite significantly. I mean, is there a lot of anxiousness in Europe that means that you want to move your portfolio away from France specifically?
We've been reducing our exposures to Europe more broadly on the equity side. And I think when it comes to the rates or the fixed income side as well, there's a two-way tussle between the growth inflation mix. Again, the concerns around European growth being so much weaker, and we've seen that from PMIs come through more recently, that actually argues for longer duration positions versus concerns over debt. It's a global theme. We talk a lot about it in the US, but as you say, it's definitely front of mind when it comes to France and the euro area more broadly at the moment as well, which argues for moving into private assets. But broadly, as I say, we are US biased, whilst we do see opportunities far more selectively when it comes to Europe and other regions as well.
But could this be the start of a real crisis in France and other countries?
We tend to look firstly at the fundamentals, and so we aren't in any way planning that this is going to be something that plays out into something more existential. We've seen events in the past, whether it be in the UK or even in the US with the debt downgrade that we saw some 18 months ago, that the term premium in the bond market can spark very quickly. You can see a very quick increase in the back end rates. And so generally when we're thinking about fixed income positions, we are keeping positions to the short to intermediate part of the curve to try and guard against the situation that you're talking about having a negative impact to the returns that we can achieve for clients. Because what we want to extract out of fixed income is what is still a very attractive yield, more so in the US, but still very much in Europe. And so by sticking to the front end, or as I say, the intermediate part of the curve, we think that you can maximize the income and the carry whilst also minimizing your exposure to back-end rates blowing out if there were to be periods of concern around deficits in particular.
Grace, thank you so much. Grace Peters there, Global Head of Investment Strategy at JP Morgan Private Bank. She stays with us, and we're looking at some of the European stocks. In fact, the political turmoil in France. I'm looking at the Bloomberg terminal, also weighing on the country's stocks. I think they're set for their worst underperformance against European peers since 2010. Coming up, we're just, well, we've had the latest regional CPI figures from Germany. The November reading for North Rhine-Westphalia rising some 1.9% year-on-year. So more on that next. And of course, the macroeconomic pressures here in France. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Well, Germany's North Rhine-Westphalia November CPI rising some 1.9% year-on-year, falling 0.3% month-on-month. For more, let's bring in Bloomberg's Jana Randau, who's in Frankfurt. Jana, great to speak to you. When you look at the German figures, I mean, it's just so hard to catch a break and have some good indications of where Germany goes next.
Yeah, so the key there is to look at the monthly change at the States report. So that is down 0.2 or 0.3 on the month, and that is roughly in line with what's expected for the country as a whole. And of course, then if you look at the corresponding expectations for the annual figure, that would probably mean an acceleration of inflation in November to about 2.3%. Not what you want to see if you're the ECB, but at the same time, that acceleration comes very much expected. Policymakers, including the president, including President Christine Lagarde, have warned that it's going to be a bumpy road back to 2%. So yes, an acceleration in Germany, the region's largest economy, of course, in November. A similar move expected for the Eurozone as well, but nothing that policymakers will be stressed about in too much of a way.
Jana, France CPI comes tomorrow with stagflation fears, and of course this political turmoil that we're watching on a minute-by-minute basis from Paris. How bleak is this for France, or are the worries overstated?
Yeah, I mean, we're going to see a similar pickup in inflation in France, if you can believe the forecasts. The overall trend is slightly lower there. And yes, of course, you're right. The French economy really has sent rather bleak signals. When you look at the latest PMI readings, they are firmly in contractionary territory, and not just in manufacturing, but also in services. And that, I think, was a big surprise, how weak services were in France, or currently are. You look at business confidence, you look at consumer confidence, all that was well below expectations in the latest reading. So there is a lot of uncertainty in France, and of course, I don't need to tell you, the government was stable, was very fragile from the beginning, and that budget fight isn't helping confidence on any level. And the fact that the finance minister, that Armand, is now signaling openness or readiness to make some concessions on the budget, that should be helpful. But of course, it remains to be seen whether he will succeed, whether they will be able to agree. And if you look at the market is taking a pessimistic view. We have 10-year yields, at the same level as Greece for the very first time ever. So that is not very helpful. A lot of uncertainty means consumers are staying home. It means investment isn't happening. So yeah, it's a serious situation.
Rihanna, thank you so much. Rihanna Hando there with the very latest, of course, on France. I have to say, we're broadcasting from Paris today, and you can hear people talking about it in the street. There is a little bit of anxiety, or certainly a lot of focus on what happens next. So let's get more thoughts from Grace Peters, Global Head of Investment Strategy at JP Morgan Private Bank. Grace, when you look at, again, we were talking a little bit about, the fact that you don't see any real crisis or contagion fear from France, but would the ECB have to step in? The ECB is already going through a tough time if they have to deal with Trump and the Trump tariffs.
Yes, and I'm going to bring it back to the growth inflation mix. We said for the US, let's not worry too much about inflation, because if you've got 2.5% real growth, 2.5% core inflation, that's 5% nominal. That's actually a pretty good situation. That's a win. The same is not the same for Europe. We've got the same trends around inflation, the notion that some of the disinflationary trends bottomed out over the summer months, and you're seeing stickiness in core. But the growth side of the inflation in the Eurozone is just not anywhere close to 2.5% real. We're looking more, 0.5 to 1%. And so the growth inflation mix is far weaker in Europe. And as you say, there's also the potential for tariffs to come next year. So I do think this leaves the ECB on a very different path to the Fed. We're expecting far more cuts from the ECB, potentially cuts of 50 basis points in size. I do think the overall mantra is going to be to not panic. They want to wait for the data. They want to show a steady hand. But undoubtedly, I think the ECB will continue cutting rates through the balance of this year and at a faster pace next year. We still don't know where the neutral rate is, whether it be for Europe or the US. This is obviously always an arbitrary figure, but it certainly feels that the neutral rate in the US is higher, and therefore there will be a shallower cutting path when it comes to the Fed versus the ECB.
Grace, thanks so much. Grace Peters, their Global Head of Investment Strategy at JP Morgan Private Bank, joining us this morning on a big markets day. Now, coming up, the U.S. Federal Trade Commission zeroes in on Microsoft with a wide-ranging investigation. So we'll have the details of our Bloomberg scoop next, and this is Bloomberg.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Now, the U.S. FTC is investigating Microsoft. We're told that the Federal Trade Commission is looking into everything from the company's cloud computing and software licensing businesses to cybersecurity offerings and AI products. Now, let's get more on our Bloomberg Scoop with Bloomberg's Peter Elstrom. Peter, great to have you. So just how widespread is this inquiry?
This is quite widespread at this point. We're seeing a number of these activities come out of the Biden administration now in the closing weeks of the administration. Lina Khan has been particularly aggressive on some of the big tech companies. We've seen that in a number of different areas beyond Microsoft. But in this particular case, what we found out, again, this is a Bloomberg exclusive, we found out that the FTC is looking into how Microsoft is handling a number of its different businesses and tying them together. That includes the cloud computing services that so many corporations buy, so many consumers use, artificial intelligence and cybersecurity in particular. What we've heard is that some of these cybersecurity breaches that we've gotten over the past year or two have raised some concerns in Washington about how Microsoft is packaging these issues. Now, Microsoft, of course, was under antitrust investigation more than 20 years ago. That was for how it was tying its Windows operating system into other products, particularly its web browser, and keeping Netscape out of the web browser market as much as it could. In this case, it's much broader than that. Microsoft was powerful then, but it's even more powerful right now. It does have a leading position in cybersecurity. In particular, that's one of the areas where they have customers, including the U.S. government, and they're a bit concerned about how all these pieces are fitting together and whether Microsoft is using that kind of market power to keep out competition and perhaps to have some of these services that are vulnerable to breaches like we saw with these cybersecurity incidents in the past. So that's going to be a concern. The question is whether the Trump administration is going to continue this effort.
Yeah. Peter, thank you so much for all, of course, this extraordinary scoop and, of course, the explanation that goes with it. Peter Elstrom. Coming up, France's benchmark bond yields matches Greece's for the first time on record. So we take a look at how political uncertainty is roiling French assets. That comes next from Paris. This is Bloomberg.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris, and these are your top stories. France's 10-year yield matches Greece for the first time ever on rising concerns about stagflation and political uncertainty. The U.S. weighs more limits on semiconductor and AI chip sales to China, but stops short of stricter measures previously considered. Plus, U.S. regulators turn their focus on Microsoft with a wide-ranging investigation into its offerings from AI to cloud computing. Now, earlier this morning, France's benchmark bond yield matched Greece's for the first time on record, putting the bloc's second-largest economy on an equal footing with a country once at the heart of the European sovereign debt crisis. Now, this comes amid ongoing concerns over French government's viability. So let's get more from Bloomberg's Valerie Teitel. Valerie, what are you looking at in the markets?
Look, we are seeing a bounce when it comes to French assets on the headlines that the government could give some more concessions to pass this budget. The CAC 40 is outperforming in across Europe today. It's up 0.8%. We're also seeing French 10-year yields decline somewhat. They did surpass those of Greece, but we're still seeing a rally on the day, which is positive, I think, for the outlook. Eurodollar, though, is maintaining its weakness. It's down 0.3%. But I want to flip on and talk about European banks, Francine, because they're also rebounding slightly when it comes to France. BNP Paribas, Crédit Agricole, and SocGen, the biggest three French banks, all in the green, unwinding some of the weakness that they have seen over the last week. But if we want to talk about pessimism, we have to look on a long-term picture. If you flip on and look at my next chart, the CAC 40 has underperformed by a very wide margin the broader European benchmarks, the DAX and the Stock 600. This margin of underperformance, Francine, is actually the second largest that we've ever seen since the creation of the euro. So it is quite a pessimistic sentiment out there. We're going to have to do a lot to unwind that if we do get this budget passed in the next month or so. While I'm on that, I also want to talk about maybe the pessimism when it does come to those bond yields in France. If we take a look at how they have compared to Greece, that French 10-year traded inside that Greece 10-year bond or just earlier this morning. Very funny to note that, Francine, especially because during the worst of the sovereign debt crisis, the Greek 10-year yield traded 3,000 basis points above the analogous French 10-year yield.
Yeah, I mean, to be fair, Greece has actually done so much that maybe they'll look at our screens and look at markets, chatter and think that's a little bit unfair. But certainly it does show all of the anxiousness that there is with France right now. Valerie, thanks so much. Valerie Teitel now. For more on the political standoff in France over the country's budget, let's bring in Femke Krummüller, Executive Director of Geostrategic Business Group at EY. Femke, thank you for joining us. Through the years, you've always been brilliant at explaining some of the political turmoil that especially France has gone through. This feels different because a lot more is at stake. Marine Le Pen has basically threatened to pull out of the coalition, to pull out of the government and go to fresh elections. Can they find a compromise, or do we go to elections early January or February?
Hi, Francine. So first of all, to answer your last question, they cannot go to elections in early January or February because the Constitution says that you can only dissolve the parliament once a year or every 12 months, meaning earliest elections can only be held next summer. That also means that I do believe the actual benefits of making this government fall are limited for everybody involved because we would still end up with the same composition of the French parliament. That being said, in my view, what is happening right now is that Marine Le Pen of the Front National, she is posturing. I'm not sure she has actually decided how she will vote, but she's clearly trying to get concessions out of the government in order to not vote against them when the budgets, because it's 3 votes in Parliament, go to Parliament throughout December.
So, Femke, first of all, if Marine Le Pen pulls out and they can't go to election, what happens? Are they deadlocked then for 7 months?
Well, we go back to square one where we were this summer, which is the president needs to appoint a new prime minister. He could reappoint Barnier. He could appoint somebody else. But because the composition of the parliament hasn't changed, there will be the same struggle in terms of finding majorities. The alternative would be to go for a technocratic government. I think that is currently rather unlikely. It's something that we've not seen in France before. I think would not fit the political culture. But so more deadlock, more lost months in a context where, of course, there's urgent need to reduce the French deficit.
Well, Femke, at this point, what is Marine Le Pen? I mean, she's really the kingpin, right? She's trying to get things. What does she need from the current finance minister and the current prime minister to keep her, happy enough for the budget to go through?
Yeah, so I think, first of all, what is important to understand is that her fundamental political dilemma in terms of voting or not voting against the government right now is that on the one hand, she's trying to cater to her base electorate, which is the electorate that is against this budget, against the government, that has been with her for a long time. And on the other hand, she's really trying to broaden the electorate by capturing new voters that actually she's trying to prove to that she's a responsible politician and that she can be in power, of course, eyeing the presidency. That's her dilemma, I think very important to understand. Now, if the government wants her to be able, let's say, in front of her electorate, to not vote against them, they will need to give her something that she can use politically. She's, in my view, made it quite clear what this could be, and it could, for example, be around the electricity tax, which is something that the economy minister mentioned already this morning.
How much, Femke, does that, I mean, again, it's always a money problem. So how much of a hole in the budget would that bring? Is there, if you do concessions, and again, we're looking at a lot of the French press, the French commentary, and there does seem some negotiation room. Is there a concern that actually the numbers don't add up, and so the EU will have to get involved?
I mean, there's always a concern that the numbers don't add up, and of course that is in the nature of the concessions right now. I think what now will have to be negotiated is what is the alternative? The alternative is a continuation of last year's budget if this budget doesn't go through, which of course does not have the same provision as this one. And at the same time, the government can try and find other things to make up for that concession that they will maybe give to Marine Le Pen. Outside of the budget, though, they do have other opportunities as well. Things that she has mentioned that are important to her are, for example, on the immigration law or on things like electoral reform. That is something that would be outside of the budgetary debate, but would also be a signal towards her party. All of that being said, of course, at the same time, the government does not want to be seen to be too close and too dependent on Marine Le Pen's approval of what they're doing, and this is the dilemma on their side.
Famke, it's pretty incredible, actually, having followed, the career of Marine Le Pen, how she's kind of changed at the margins, being more business friendly. Just 6-7 years ago, she was quite anti-Europe. Now she seems to be, put that to rest because it's not really playing out with the electorate. It's very clear that investors today are steering clear of some of the French assets after this flare-up. Would she be worried by that? Is it something that she cares more than 5, 6, 7 years ago?
I would definitely think so, especially for the reason that I explained before, which is the fact that she's trying to attract a broader, newer electorate that would allow her to get a majority in a potential presidential election. And this electorate is actually an electorate that, as I mentioned, cares about stability, but also cares about, for example, the attractiveness of France, the business environment, and the instability. We've run a survey at EY on France's attractiveness for foreign investors, and 50%, almost 50% said that they have actually delayed or stopped further investments into France, given the current uncertainty. And so this is something that matters also to part of her electorate, actually.
Famke, thanks so much. Famke Krumbuller there from EY's Geostrategic Business Group. Now, Rémy Cointreau dropped as much as 5% after it forecast a larger than expected drop in annual sales. Now, the cognac maker says it expects organic sales to fall by up to 18%. The firm also adds it does not expect a recovery in U.S. markets until at least the end of the year. Unlike rivals, Rémy has resisted lowering prices to protect its margins. Now, coming up, the UK government backs down from its EV sales mandate as a threat of US tariffs looms over the economy. More on that story next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Some of the economic policies of Trump may lead to higher economic growth, being pro-business, keeping tax rates low, deregulating the economy. But unfortunately, many of the other policies are going to have an implication of higher inflation and lower economic growth. The first thing he has already announced is going to be tariff against Mexico, Canada, and China, and that's only the beginning.
Well, that was Nouriel Roubini, the chairman of and CEO of Roubini Macro Associates. Now, the UK government has vowed more support for the nation's car industry and will consult with manufacturers and changing an electric vehicle sales mandate that they will not meet this year. Let's get more from Bloomberg's Craig Trudell. So, Craig, thank you for joining us. How have EV sales actually been faring in the UK?
They can sort of be deceiving because they're actually doing okay, but the problem is that they're not doing as well as the government is trying to mandate. And the only reason that they're doing okay is, if you believe the manufacturers, is that they're discounting like crazy. The industry's trade group estimates that the level of discounting of EVs will be somewhere around £4 billion this year, which is quite a big sum and something that they, for sort of understandable reasons, say is not sustainable. And when you look at the whole industry and the share of sales that are battery electric vehicles, you have to take into account that some of those manufacturers are only selling EVs, Tesla, for example. And so that inflates the industry number, and this is a regulation that's manufacturer by manufacturer. So there are a lot of companies that are nowhere close to meeting the 22% share that the government has tried to mandate for this year. And those figures only go up between now and 2035.
So, Craig, UK car output, I think, dropped around 15% in October, and that marks the 8th consecutive month of decline. Put that into context for us. Could the decline even strengthen further?
Yeah, I think the outlook for next year is not good. You have an industry that is putting a lot of investment into trying to make this switch over from petrol and diesel cars here to making electric vehicles that, when you look at the domestic market, the amount of government support and incentives has been pulled back over the last few years. That's part of, what we're hearing from the government is when they say that we'll offer more support, I think there's going to be some rethinking of those incentives that have been pulled back. The industry would like to see, for example, a lower value-added tax on new electric vehicle sales so that more consumers are buying them. Because what we're seeing is a lot of purchases of EVs is actually, through salary sacrifice schemes or company cars. And so the sort of lay consumer in the UK, or the typical consumer in the UK, just isn't buying. And that has to change for these plants to be able to sort of have the demand that is commensurate with the capacity they're putting in. And we also have to think, too, the export markets, much of Europe is having a lot of the same issues of incentives being taken away and the momentum having left the industry as a result of that.
Craig, what does Donald Trump actually mean for EVs in Europe and the U.S.? We could look at extra tariffs. He's not probably the most climate-friendly president the U.S. will have, but he also has Elon Musk as a sidekick.
Yeah, I think, that may actually be one source of optimism. When you look at the numbers that were reported overnight, about the production figures, there was a big bump in exports to the U.S. And I don't know whether that is sort of some, preemptive, moving by manufacturers to kind of, get as many cars sent to the U.S. Before any potential tariffs. We've not heard Trump single out the UK. He's at least to this point only threatened Mexico, Canada, and China. It may only be a matter of time before he does the same with the UK and Europe, because we know that he's not particularly happy about the fact that, in his words, he sees, Mercedes-Benzes all over Fifth Avenue, and you don't see Cadillacs or Lincoln in Berlin, say. And so I do think that that is absolutely a concern, that on top of all of these regulations, on top of the challenges that companies are having with selling EVs, there are real worries that these trade measures will only make their lives more difficult when Trump is in office.
Craig, thank you so much. Craig Trudell there with the very latest on cars, EVs, and of course the Trump administration. Coming up, Ukraine faces tough choices as fears grow of the U.S. pulling support from its war against Russia. We'll look at Kyiv's options next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in Paris. Now, countries in the Nordic region have long been among the most vocal about the threat of war on their doorstep. Now, Finland has launched a website showing people how to prepare for any type of crisis, including how to last 72 hours in the event of a conflict or other crisis. While neighboring Sweden has begun mailing updated leaflets to households urging a greater emphasis on preparing for war. So let's get more from Bloomberg's Nordic Managing Editor Kari Pajapalo. Kari, why are European countries now stepping up this preparedness?
Hi, Francine. Russia's war in Ukraine has really hit it home for Europeans that war is not something that exists in history books. It's something that can happen here as well. And given the primary job of governments is to keep their people safe, a lot of European governments have sort of woken up and started preparing now. There's also awareness that climate change will bring on a lot more extreme weather events like the floods you saw in Spain very recently. We've just come out of a pandemic a few years ago that was global. So there are a lot of threats that people are starting to consider.
So, Kari, what's happening in different countries and what's the EU's role in this?
You already mentioned that Finland's set up a new website to give guidance to people on how to deal with various crises. Sweden's mailing leaflets to people, but there are also other things being done. Lithuania is stockpiling medicines as part of a big European Union effort to put in medical stockpiles in 22 stockpiles in 16 European Union countries. And then in Denmark, they're thinking about a scenario in which the financial sector would need to kind of take care of people in case a power outage lasted even as long as a week. Like, how would you pay for your groceries? And what they're doing is they're making sure that all debit cards will continue to work throughout that entire week because people have so largely moved away from cash now. And then Norway and Sweden are among countries that are thinking about bringing back grain stockpiling that in a lot of countries in Central Europe, in Finland, they just always continue to do that.
So, Kati, tell us why is Finland actually seen as a blueprint for other countries in terms of preparedness?
Well, Finland has always felt that there's a threat on its doorstep. There is a very, very long border with Russia, but the country has also experienced famines. And it is just 100 years ago that people were still baking tree bark into bread to survive. Finland is surrounded by sea on all of the sides where its main trade partners lie. So it's very hard to bring in supplies during a crisis. And that's why preparedness has been something that the country's been doing for almost 100 years. Since the 1950s, they really started organizing that. And because it's been going on for generations, it's become this thing that people just do. It's part of the mental awareness, the psyche of the country.
So, Kati, can you talk to us about the relationship? I mean, what kind of relationship do the leaders in Finland have with Russia right now? It's been, frankly, a war that's shocked many. Is there still some kind of diplomatic relationship?
No, there's not on the political level. There is a long border, and border authorities do naturally have contacts with their counterparts on the Russian side. You have to on the practical matters. There is a canal, Saimaa Canal, that half of which goes in Russia. That is the only kind of navigation route into Finland's Lake District from the Baltic Sea. And there's cooperation on that front as well. But really, it's only just the daily practical matters. There is no political relationship and no contact.
Okay, thank you so much. Our Nordic managing editor there, Kati Pohjanpalo, of course, leading a fantastic team, breaking a lot of news and giving us a lot of great Bloomberg stories that you can also find on the Bloomberg website. Now to some other stories making news. France's richest man, Bernard Arnault, is set to testify in a criminal court today. Now, the LVMH chief executive says he is completely unaware someone was trying to blackmail him. The case actually centers around one of the billionaire's former bodyguards, Anna Paparazzo, who allegedly demanded 300,000 euros in exchange for photos of him with a woman who was not his wife. Direct Line Insurance has rejected Aviva's £3.3 billion takeover bid, saying it substantially undervalues the business. Well, under UK takeover rules, Aviva has until December 25th to announce a firm intention to make an offer or walk away. Now, it's a second takeover bid rejected by Direct Line this year, following a proposal from Belgian rival Ageas in March. And Inca Group, the largest IKEA franchise, saw a sharp decline in full-year profit after a round of price cuts and tough economic conditions weighed on the bottom line. Now, the Swedish furniture seller reported a 37.5% decline in operating profit to 1.3 billion euros for the financial year through August. Up next, Bloomberg Brief, Danny Berger and Manus Krani in New York. We'll have a full roundup of everything that's happening, of course, in France. Happy Thanksgiving to those celebrating in the U.S. This is Bloomberg.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Hi, I'm Laurie Haynes, CEO and co-founder of Shirar, and I'm really excited to tell you that we are going to be raising funds for Shirar again. After a successful raise in 2023, it's time to scale.
We hope that you enjoy the pitch deck and the financial model. Any questions, please don't hesitate to ask us, and we can't wait for you to be part of Shirar.
For Black Friday. Over here in Europe, we are very much talking about what is happening with the French bond market and by extension, what is happening with the Eurozone. That's been the big story of the day. The French 10-year OAT Bund trading just north of 3% at the moment. That means critically that it is trading 84 basis points over Germany. That spread has been widening. Earlier on today, we saw French bonds and Greek bonds trading at the same level. Who'd have thought that would have ever happened? Anyway, that's the focus, and it's rippling out into other asset classes as well. We've also seen euro-dollar reacting to some of the CPI and inflation data that we've got around Europe as well. That's being factored in. Some Spanish data moving the needle a little bit earlier on. And European stocks are broadly bid this morning, which is interesting considering actually we saw something of a tech sell-off in the United States yesterday going into the Thanksgiving Day holiday. We'll continue to monitor obviously what happens there. We've got some big stories breaking within the tech space, and we'll come back to those potentially a little bit later on the show. But France is the focus this morning here in Europe. As we've already indicated, French assets very much under pressure. The country facing a deepening political crisis, a possible no-confidence vote threatening to oust Prime Minister Michel Barnier, causing huge uncertainty for investors. Let's talk a little bit about what is happening here and get a sense of what is going on. We are joined now by Caroline Conan. She joins us to talk about what is going on and how the latest moves are affecting asset prices. Caroline, let's talk a little bit about what is going to be happening today. We've already had the French finance minister on the radio, maybe trying to calm the situation down. We've also got an interesting vote coming up a little bit later on pension reform. Talk to us about what is happening. Give us the update.
And it's actually very interesting, Guy, because earlier when you saw that the French borrowing costs were actually matching the Greek levels on the 10-year bond market, then at the same time, the finance minister, Antoine Armand, was speaking on the radio, trying to reassure the markets. Obviously, what we've seen over the past couple of days with these spreads widening between the French and the German 10-year and reaching the highest level since actually 2012. So we heard from the French Finance Minister Antoine Armand saying it's actually better to try and negotiate this budget, to try and update this budget, rather than having no budget at all and risk a possible government collapse before Christmas. So that's what the French Finance Minister was saying this morning. Later today, as you were mentioning, we're going to have a vote on the pension reform. You may say, like, what's going on? The pension reform, that was last year. Well, actually, the far left is proposing to repeal this pension reform. The vote might not actually take place because Macron's party has put 1,000 amendments to be discussed before midnight, so trying to sabotage a vote. But if a vote does happen, it is very likely that the National Rally and the left wing would actually join forces together to try and abandon this pension reform, and that would actually not bode very well for a possible vote of no confidence against Michel Barnier over the next few days.
Over the next few days, which is interesting, the timeline seems to be getting a little bit shorter. Caroline, let's talk about Marine Le Pen and the position she finds herself in. Over the last few days, I've listened to what the RN leader has had to say, and it sounds like she's digging herself in deeper and deeper and deeper. The finance minister was talking about concessions earlier on. How big do the concessions need to be to allow Marine Le Pen to change tack here?
I mean, you know, Michel Barnier is looking for 60 billion euros for this budget in order to bring the deficit from 6% this year to 5% next year. So obviously the money is going to be found somewhere. He wanted to delay, for example, the indexation of pensions until July. Well, Marine Le Pen is against that. He wanted to possibly raise some taxes on electricity, given electricity prices are going down. Marine Le Pen is also against this. And he also wanted to perhaps have less reimbursement for some medicine. Marine Le Pen is also against this. So lots of big concessions. That's obviously going to have an impact longer term on the deficit and on the French debt. And Marine Le Pen really said that all depends on whether the French government really hears her red lines.
If the budget stays the same, yes, this is not a surprise. We always said it for the past 3 months. I'm telling you, if this budget is not approved, the budget of last year will apply, and actually it's not as bad as this one, as there are less taxes for the working and middle classes.
We'll see if there is a first vote of no confidence happening as soon as next Wednesday on the social security part of the budget. And, you know, it's Thanksgiving, guys, so I got to give you a Thanksgiving quote. We heard from one of Macron's ministers, Marc Fesneau, in charge of the relations with the parliament, and he said, "We are like turkeys waiting for Christmas."
Or in this case, Thanksgiving. Caroline, perfect. Thank you very much indeed. Caroline Conan joining us out of the French capital on the politics of what is happening with the French budget. Let's talk about the market reaction around all of this. France's benchmark bond, the OAT, matching the yield on Greece's for the first time on record earlier on today, putting the bloc's second largest economy on an equal footing with a country once at the heart, remember, of the European sovereign debt crisis. Let's put this all together. Let's start with bonds, then we'll talk about stocks. Valerie Teitel is here with the details.
Yeah, Guy, it was really surprising for me to see this happen today. We saw these Greek 10-year yields trade inside those of France. Just guess what the wides were during 2012 of the sovereign debt crisis, Guy. 3,421 basis points is what the spread was at the most widest back in 2012. We are now now trading on par. The market is pricing in the credit of France equal to that of Germany. But there is some other things worrying about the French bond market. One more topic I do want to touch on in this, guys, if we flip on to my next chart, is what French bonds have been doing on asset swaps. So this is the French bond yield versus its equivalent swap rate, Guy. This is important because a lot of bank treasuries hold French OATs on asset swap. That position has been very much underwater, and we've seen this asset swap widen very aggressively this year, Guy. A lot of this is the market telling us that we are unable to digest this market supply of bonds as it's coming through. But if we look just short-term picture of how French assets have traded this morning, we're in the green when it comes to the CAC, up 0.8%. But Guy, the long-term picture on French equities, especially year-to-date, does look very different.
Absolutely. Valerie, thank you very much indeed. Let's carry on the conversation around what is happening with European stocks, French stocks in particular. The turmoil is not just limited, though, to France. Remember, Germany also facing some significant issues right now. Daniela Costa, head of European capital goods at Goldman Sachs, joining me around the table. Good morning.
Good morning. Thank you for having me.
We have a really difficult political environment in Europe at the moment, at the same time as we are watching US markets take off. Is there an argument? How do you make the argument, should you make the argument at the moment, that European stocks are super cheap, capital goods stocks are worth, therefore, looking at, and Europe is worth re-examining? Is that, in the current environment, is that an argument that is easy to make?
It's an environment, as you say, of a lot of uncertainty. I would say we've spent the post-pandemic period 21 to the beginning of this year actually at a significant premium for the European capital goods stocks compared to the European market overall. This has finally winded down, and we're very close to the roughly 20% 12-month forward price-to-earnings premium that the European capital goods has traded over the last 15 years. So I wouldn't say we are at extremely depressed valuations in the group as a whole, but there are very significant dispersions. For example, the electrical equipment, energy transition geared names are still trading at a significant premium, and the machinery, more cyclical, geared to industrial production names are actually trading at a big discount to history.
Does your world also include defense stocks? Is that something that we should also be factoring in as well? Because names like Rheinmetall have had a very good run over the last few months. That takes us back to the kind of transatlantic trade story and the reinvestment story that Europe needs to put together.
Yes, the European defense stocks have continued to trade at very significant premiums. There were big outperformers year to date. Yeah. And obviously, I think with all the uncertain geopolitical climate, the pressure on Europe to move to 2% of GDP in defense spending is something that investors continue to see playing out in the next few years.
Do I think about some of these capital goods companies as being global companies, or do I think of them as being European companies? Because many of them have significant footprints in the United States. Schneider's one of them. You look at plenty of others. Siemens is another one that has a big footprint over in the United States. Rolls-Royce, by definition, its kit moves around the world with relative ease. Should I look at these stocks and think, these aren't European companies, they're global companies, and they trade at big discounts because they are European companies and therefore represent good value?
Absolutely. To give you an idea, it's about 40% of the revenues for the average capital goods and industrial company that we cover that sits in Europe. It's about a quarter in the US, roughly 15% in China, and the rest worldwide. So they are definitely global companies. And you touched upon the discounts versus the US market. This is true. If you look at European capital goods companies versus US capital goods companies, we're very close to a 15-year trough in terms of the multiple.
Does the politics impact the capital goods sector? In theory, it should. You've got big programs running on both sides of the Atlantic in terms of the green transition, in terms of rearmament. Are these kind of big geopolitical themes, how are they feeding in and being priced? How accurate is the pricing around some of these big themes?
100%. These topics are all very relevant given how global the companies are. So in the last couple of years, we had the topic of IRA and energy transition, and the European companies, particularly, especially the electrical equipment names, are very well positioned to satisfy that need for higher utilities and energy efficiency topics. There's more uncertainty on some of those at the moment, but this has been the story of the last 2 years. On another end, there are also big plays on China compared to US companies, which have much lower exposure. So all the question around both tariffs and Chinese stimulus is paramount for the debate now.
When you talk to American clients, though, what do they say? Why do they push back and say, why do I want to buy a European company right now? Because that seems to be the sense that when I talk to portfolio managers that are in the States, they're scratching their heads wondering why they haven't any allocation into Europe at the moment.
100%. I just came actually from the US, from some marketing there, and almost every meeting I sat with, people I'm not exposed to more than maybe one or even no stocks in the European industrial space at the moment, and I see them between a rock and a hard place, where for every thematic topic that people might like at this point, reshoring, data center investment, utility investment, there's a US name where you don't have to worry about China and you don't have to worry about tariffs, and so people think the valuation discount that you see now in European capital goods versus US is a consequence of that.
Given the tariff story, does that discount get bigger? Is that something that we should think about? Is it going to become harder? Or do these companies have big enough footprints in the States, Airbus, etc., manufacturing in the United States, that they can avoid some of these tariff concerns that maybe smaller companies won't be able to?
Yes, I think it very much depends on the magnitude of tariffs and where those tariffs are put through. To give you an idea, basically roughly 80 to 85% localization is what our companies have currently of the footprint they have in the US. So they are still net importers, and half of those imports come from Mexico, the rest is split between US and China. So the magnitudes will make a big difference. We obviously have the case of 2018, 2019 tariffs, where we were talking sort of 20-25% tariffs, and those were passed through, and they ended up with just higher prices. These companies tend up to have pretty good pricing power, and they're US competitors. They're not 100% US either. They also bring in some components. They're parts of the value chain, like things like LED, for example, or some electronic components that you don't have the ability to do in the US.
Would a significantly cheaper euro make life easier for these companies? Can we compensate one for the other?
Yeah, I mean, the dollar appreciation is a slight positive, but the sector is fairly well balanced between exposures, so it's not a big earnings delta. In the aerospace and defense side is a little bit different. That's where you're more geared to the dollar, euro, and that makes a difference in your earnings estimates.
Great to see you. Thanks for stopping by to see us. Daniela Costa joining us from Goldman Sachs. We'll go from capital goods to the tech sector next, checking on what is happening in the United States. We've seen the FTC opening an antitrust investigation into Microsoft, the outgoing Biden administration weighing additional curbs on sales of semis as well into China. We'll talk all about that next. This is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
16 minutes past the hour. Happy Thanksgiving. Let's talk about what is happening stateside, particularly with the tech sector. Microsoft is facing major headwinds after the US FTC opened an antitrust investigation into the tech giants. Now, the Federal Trade Commission has sent Microsoft a demand detailing a long list of areas that it wants to scrutinize. This is everything from software licensing to cybersecurity to AI. Let's talk through what the implications of all of this are. Tom McKenzie joining me around the table. This is substantial. This is a big ask from the FTC. How big a blow for Microsoft is it?
Yeah, and coming towards the end, as you noted, of FTC Chair's Lina Khan's term, of course, as she looks to step down at the end of this term. It is a significant move. They spent more than a year talking to some of Microsoft's competitors in an informal way. They've been piecing the evidence together, and they now made a formal request to Microsoft to hand over information. And their particular concern is around the bundling for the cloud services offerings of Microsoft with their software and with their cybersecurity. And there's a couple of elements to this, two key elements, I think. One is national security. You'll remember the CrowdStrike outage impacted one of your favourite sectors, the airline sector, quite dramatically earlier this year. And then the fact that it's a reminder that Microsoft is a provider of billions of dollars worth of software to the US government, and notably the Defense Department. So there's a national security element, and then there's the anti-competitive element, the bundling of some of these services and what it means for other competitors, like, for example, Zoom, getting some of their products in front of customers. So those two key elements seem to have come together. We'll wait to see what information Microsoft ultimately is compelled to provide to the FTC, and, of course, whether or not the Trump administration continues this.
Well, let's ask that question about the Trump administration and what it is likely to do. If I listen to J.D. Vance, the vice president coming in, he seems to be signalling quite a tough line, and almost a continuation of the Lina Khan-type strategy that has been developed under the Biden administration. There was this assumption that Trump would be easier when it comes to regulation, but is that necessarily true when it comes to big tech?
Well, I think you're going to see those competing tensions within the administration, and whether they have a clear line on this has still not been firmed up. There's a concern amongst parts of his administration, incoming administration, around, for example, quote unquote, free speech. And so you have, for example, Zuckerberg from Meta meeting with Trump in Mar-a-Lago to try and make the case, probably you would expect, that they are doing what is expected them to allow an open platform on Instagram and Facebook. Then, of course, you had Jeff Bezos famously making comments after the election, of course, of Trump, and then having those conversations with Trump and not putting out that editorial in Washington Post. So the tech titans are around and trying to lobby this incoming Biden administration. You're right that J.D. Vance comes from a particular part of that conversation, and then there are those more traditional elements, the incoming Treasury Secretary, for example, who may be pushing for a relaxed view when it comes to what has been a pretty historically aggressive FTC push under Lina Khan against corporate consolidation of power, as they would frame it.
They would talk about breaking up some of these big companies. Just a kind of question on the chip sector. You are looking at ASML, the biggest points gainer on the Stoxx 600 this morning. We've seen the Biden administration announcing that it is going to impose further sanctions effectively around the Chinese chip sector. The first thing I read this morning was that this wasn't quite as draconian and maybe as originally anticipated, and therefore you would have thought would be slightly better for Applied Materials. But it turns out that actually stocks like ASML, the lithography equipment out of Amsterdam, doing well this morning. Can you just explain what's going on?
Yeah, a part of it is the expectation within the ecosystem that you are going to get a continuation in terms of the ramp-up of pressure when it comes to restrictions on exports of certain parts of the tech space, the chip space, into the Chinese market. We know the Biden administration has been pressuring the Netherlands, pressuring Japan to try to align with the restrictions that are already in place for US companies. Now we expect the details to come through on the latest restrictions, but some companies, particularly providers of hardware to Huawei, for example, some of those have been reportedly left off the list. They'd been initially on that list, now they've been taken off that list. It seems like the threat that they've been reaching for, the Biden administration, to impose those restrictions on the Netherlands and Japan via that particular rule that they have at their disposal, that hasn't yet been put to play.
Right.
And they have reduced the list, the number of names on that list.
Tom, great stuff. Thank you very much indeed. Tom McKenzie providing clarity on what is happening in the chip space. Next, we're going to shift to what is happening in the Middle East. Geopolitical tensions remaining high. OPEC Plus delaying its meeting, trying to figure out what it's going to do next. Does the oil market really need more oil right now? We'll discuss that next. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Welcome back, 24 minutes past the hour. OPEC Plus has confirmed a Bloomberg story that the organization is delaying its next meeting. Let's find out exactly what is happening here. Al Nightingale, who leads our EMEA oil coverage, joining me around the table. OPEC's in a really difficult place right now. The market doesn't necessarily need any more barrels, but it's been itching to deliver more barrels. So is the delay basically to try and buy itself a little bit more time? What's going on?
I think that's right. I think you've nailed it, really. Essentially, there's pressure from within to add barrels. The UAE in particular has plenty of capacity and has long been pushing for extra to be able to supply more.
Yep.
At the same time, everybody's acutely aware that the market next year looks oversupplied. So you're about to start adding barrels just when the market really doesn't want them. And I think it speaks to the difficulties that OPEC faces right now.
So what are the potential solutions to this?
Well, the obvious thing is a delay.
More delay. Okay.
Yeah. So there were kind of voluntary cuts that could have happened this year that they've put off. I think it was, there was a greater expectation that they would proceed with extra barrels next year. But as I say, the market doesn't need that supply, and I think there's going to be pressure from the market to not add the barrels.
Great story this morning. Thanks very much indeed, Al Nightingale, on what is happening in the oil market. Joining us next, Jordan Rochester and Mizuho. We're going to be talking about what has been happening with the dollar recently and where we go next. This is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason I love thinking about black swans, and at the office everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Happy Thanksgiving. Welcome back. Let's talk about what is happening within the Eurozone. The Euro's under a bit of pressure today. Inflation data out of Germany. The States there suggesting maybe a small rise in headline inflation. You've also seen a similar story when it comes to Spain. But that's not the real story surrounding what is going on within the Eurozone right now. The story is that there's chaos in France, and we've got a few problems in Germany as well. But the French story feels more acute at the moment, and we are waiting for potentially the government there to fall. Jordan Rochester joining us now around the table from Mizuho Bank. Good morning.
Good morning.
What's the relationship between French politics, chaos in French politics, OAT spreads widening out over Germany, and the euro? Because the two don't necessarily seem as correlated as maybe you would first think.
No, because the euro correlates to German rates typically. Whatever the Bund is doing, whatever the German data is doing, that's what matters for the euro. But it does matter if you get a period of time where, for example, in 2017 or so, we were all very optimistic on the euro, with Macron winning in the French elections, and we had Euro Swiss go up towards 120. That sort of level, and then you had the Italian politics blow up in 2018. So if it had been the case that investors were super optimistic on France going into this mess, it would have been chaotic, but they weren't. So we kind of have a market that was already ready for this pessimistic view on France. The politics seemed really hard to square. Yep. The idea of Le Pen accepting what Barnier has put forward, it's like turkeys voting for Christmas. When do politicians want to vote for tax rises? Yep. It just doesn't happen.
So is all the bad news in the price on France?
I'd say that the problem with France is it's one of the largest issuers in Europe, and now you've got a bit of a buyer's strike. We just had, I had a head of EGB trading was just in France recently, talking to investors, talking to real money investors, and the interest in buying oats here was extremely low. It was quite striking to us. And you've got other options. You've got Italy, you've got Spain, and their data is actually fantastic. You've got unemployment falling in both, where in Germany and France, the outlook's just much more dire.
So in terms of what happens next, do we just continue to see the euro grinding lower? Is that the trade that you think will probably continue to be put on? I know we've got a little volatility around at the moment. The more medium-term picture, is it a sort of grind towards parity?
I think this is the most clear macro trade there is, which is euro area underperformance versus US. The only problem I have is everyone agrees.
Yep.
And it becomes a really consensus view. And we're seeing that play out this week. We've got this big month-end rebalancing flow going on. We were worried about strong inflation in Europe this morning. It seems like that's not too much of a worry. You've got the Trump trade slightly coming to a bit of a short-term pause. So the euro shorts have been hurt this week, absolutely. So the idea of getting to 106 is quite possible because this month-end rebalancing flow from pension funds, they've made so much money in dollar assets, but they have to hit their allocations back to Europe. So you'll see a bit of dollar selling as we go into the weekend. But when we get to next week, we've got non-farm payrolls in the US. It's going to bounce back because of that hurricane impact. So I think the euro-dollar downside trend is back on. We're looking for 103 towards 101. That's December, January. The euro area's got a bit of reprieve. I know France has blown up in a way.
Yep.
But Trump didn't mention on Truth Social any tariffs about Europe.
Yes.
Didn't mention Japan. Why? That's what we need to get the answer to. He's not yet in office. We wait until January the 20th for that. If Europe gets a sort of a negotiation, then the markets will be a lot less pessimistic and euro would bounce back. But I'm of the view that Europe's in his crosshairs. He just hasn't got around to it just yet.
Okay, so assume that does happen, that the crosshairs are finally trained on Europe and it finds itself in a difficult situation on tariffs. Is there a significant enough centre of gravity in Europe to say, right, we need to respond? Is the Commission strong enough, without France and Germany having obvious leadership right now, to deal with that? Is there enough leadership to deliver the Draghi report? Are countries really going to get on board at a supranational level to deliver a response, considering they can't really deal with their own domestic politics?
I think there is, but as time goes on, it gets weaker and weaker and weaker. The pro-EU bloc are slowly losing power. In 2020, when we had COVID, when we had the EU SURE programme, when we had the Next Gen EU, it was a fantastic time for policymakers. You had pro-EU in France, pro-EU in Germany, Italy, you had Draghi, for example, and of course Spain. So it was a lot easier to get things done around the table. This time around, you've got Le Pen, you've got Meloni, you've got the French politics in a mess, and Germany, Scholz is facing an election in February. It's a lot more difficult. But when there's a will, there's a way. If you've got tariffs being thrown on Europe, you've got the German auto sector, probably the weakest spot in Germany, in Europe right now, in terms of sectors. When Germany's under pressure, the idea of fresh issuance, an EU-level issuance to counteract this US problem, I think will be quite an easy sell for politicians.
I'm just going to quote a line from my good friend and colleague, Simon White, who's written a nice piece this morning talking about the dollar being on borrowed time. When everybody agrees, he says, something else usually happens. This is coming back to what you're saying. There's a broad consensus that a Trump redux will bring a stronger dollar. Give me the kind of the tail risks around this stronger dollar story. Everybody agrees we're going to get a stronger dollar, we're going to get a weaker euro. As Simon says, usually something else happens. What could cause something else to happen here?
It happens most years, actually. So December, you've got very strong seasonality for a weaker dollar, on average 1% down. Hit ratio is about 70%. For stocks, it's even better. There's an 80% hit ratio of stocks heading higher into year end from here onwards, from around Thanksgiving. And when stocks go up, typically the dollar weakens because it's risk on.
Yep.
So you're fighting seasonality. The last time the seasonality didn't work, 2016, when Trump won. So there's still the potential for the dollar to strengthen in December like I think it will. Then we get to January, and everybody like myself on the sell side at banks writes an outlook piece. Here's my top 10 trades.
Yep.
And by January the 15th, usually 7 out of 10 are stopped out.
Yep.
And when people go sit down January the 1st or the 4th, whenever the actual first trading day is, they look at the consensus trades, they look at what the big positions are, and they go, you know what, let's squeeze them out of it. And I think the January turn is very real for this dollar trade. I'll probably be worried about this.
Big trade, though. There's a lot of kind of weight of money around this, though. And do you not need to see something fundamentally shift in order to provide some sort of a tailwind for those trades to be put on?
Absolutely, and it's this Scott Bessent Treasury pick that has provided the tailwind this week, along with the month-end rebalancing flows, because markets are now saying maybe Trump's going to be a negotiator on tariffs, like he was in 2016 to 20. I don't think he will. I think on January the 20th, we'll have executive orders with tariffs being announced and implemented within a month or so afterwards. I could be wrong. And if I'm wrong about that, then the dollar strength story just doesn't play out as well. We are looking for stimulus from China and Europe. That could also change the game. I think Q2, if China has tariffs on it, which he's said he would on Truth Social, I don't think China's going to have much negotiation on this. Maybe China does a big fiscal stimulus at the end of Q1 into Q2, and that would change the tide for everything.
I can't believe we've had an entire conversation talking about euro-dollar and not mentioned the Fed or mentioned the ECB. What role do they play in this process?
Yeah, they absolutely do. So look, the ECB, in the short term, is a little bit too much priced into the next 2 meetings, in my view. But the markets have to price the probability of a 50 basis point rate cut in December or Jan from the ECB. The PMI data was woeful, but the inflation data has just bounced. Yep. So we're above 2% again in Germany, 2% in Spain will be the case tomorrow in Euro area. We're hovering around 2%. So I don't think it's enough data for the Germans and the other hawks at the ECB to get dovish for 50. January is probably too soon as well. We just don't have enough data.
Yeah.
I think the trade, though, is pricing a lower terminal rate for Europe. The market's pricing around 175. Yeah. We're looking for 150 or below. The market's way too anchored on this 2% neutral.
So where do you think neutral is? So they're going to become... the moment we're restrictive, we're going to go through neutral, and we become accommodative again. That's basically the trade.
I can agree with 2% being neutral, but I think they don't need to cut to neutral. They need to cut to accommodative to 1.5. That's the view from us here.
How quickly do we... how big an effect is that going to be? You look at the kind of the politics and you think, can monetary policy really do anything here in terms of... I appreciate it's going to move the currency, but can it do anything else other than move the currency?
Well, they need to have a weaker currency to offset any tariffs for a start. So they need to do that. The monetary policy, going 50 basis points below neutral, no, it's not very useful. I mean, look at Switzerland right now. They're going towards zero again in terms of their pricing. So we could be in a case next year where none of the good news happens in Europe and we have to talk about getting to nearly zero again.
So the ECB goes through neutral. What about the Fed?
The Fed's a very different story. So 3% GDP growth, inflation's above 2%, unemployment's at 4.1. It's a mixture, to me, that says they don't really need to cut that aggressively. So we think they either skip December or Jan and a 4% terminal rate. So you've got this huge wedge between where the Fed will end up at 4% and the ECB at 1.5.
Is 4% still restrictive?
In their view, it's more towards neutral, for sure.
Wow, so that's the gap. That's the delta.
It's like slightly tight, yeah.
Yeah. And in terms of, therefore, where that leaves us, given that spread's big, and you've basically got two central banks, two of the major central banks in the world, doing very different things. Why would I not continue to own the dollar in that kind of environment?
It reminds me of the big divergent monetary policy trade that took place in 2014, 15, and 16. So when Trump got elected the first time, we had negative rates in Europe. We had QE. This time round, Trump's got elected. We don't have that in Europe, but we're moving towards it. So it feels a bit more like 2014 when the ECB cut to negative and did QE.
I'm trying to think of wildcards that could throw us off this. BOJ, hiking aggressively?
I'm super optimistic on Japan. There's a structural change taking place in their labour force. So we think that they raise rates to a 1% terminal rate. We're at 0.25 now. But it is a slow-moving train. It's going to be every 6 months you get a rate hike. So that 1% will get to in 2026. But look at the labour market data. We're having record highs in the modern version of the labour statistics. Using the old ones, we're at 1992 levels of wage growth in Japan, but with 2006 level of interest rates. We should be much higher. So wages would say 2%.
Is there a repatriation trade that goes with this? Because everybody's talked about this repatriation. Once the BOJ flips, you're going to start to see money pouring back into Japan. I haven't seen it yet. Does it happen? It's
going to happen if it hasn't happened already, because you're seeing the 2-year swap rate, for example, move very quickly in the past few weeks. So JGB is becoming more attractive for local investors. So I think the main thing is it slows down the local investor outflows, especially with what's going on with France. And they're usually a big buyer of France.
Big buyers of European government bonds. Great to see you, Jordan. Thanks for stopping by. A real tour de force in terms of what we've been watching around the world. Jordan Rochester of Mizuho, thank you very much indeed. What we got for you next? Nouri Rabini's warning on those Donald Trump proposed tariffs. We'll hear what he has to say next. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race and Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
But what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
43 minutes past the hour. Welcome back. Investors a little uncertain on the impact that President Trump-elect, I should probably say, will have when it comes to the tariff story. Many concerned that we could see adverse effects on the global economy. Famed economist Nouriel Roubini warning that the policies may lead to higher inflation and lower growth.
Some of the economic policies of Trump may lead to higher economic growth, being pro-business, keeping tax rates low, deregulating the economy. But unfortunately, many of the other policies are going to have an implication of higher inflation and lower economic growth. The first thing he has already announced is going to be tariff against Mexico, Canada, and China. And that's only the beginning. He has said we might have up to 20% tariff on all our trade partners, up to 60% against China. He wants to have massive deportation of people. In the last few years, the increase in migration has kept the lead on wage growth, has increased the labor supply, has increased economic growth. So definitely mass deportation is stagflationary. He wants not only to make all those tax cuts permanent, but he made other promises. No taxes on tips, on overtime, on Social Security, on income earned abroad, and so on and so on. It's estimated these things may add to the deficit by $8 trillion. Too much demand, inflationary. He might want to weaken the dollar. That's going to be inflationary. He may interfere with the independence of the Fed. Getting out of the Paris Accord is going to make climate change much worse, increase food prices and things of that sort.
It's interesting, Nouriel, a lot of things you just said are what a Bitcoiner would say as to why you should buy Bitcoin. There's now the Bitcoin ETFs. They're over $100 billion, clearly a big hit. There's talk that it could be a strategic reserve. You have gold in the portfolio. Is there anything that could move you to add Bitcoin to your ETF to help accomplish some of these goals?
You know, the Bitcoin is highly volatile. It can go up by 10% one day and down 10, 15% another day. If you want to have a stable store of value, you would not put Bitcoin into your portfolio. The kind of assets we're actually thinking about are all assets that do well when you have lower growth and you have higher inflation, whether it's tips, short-term treasuries. Gold is a hedge against inflation, debasement, de-dollarization, geopolitics, financial crisis, some exposure to ag commodities that are going to do well in a world of inflation and of climate change, and environmentally sustainable REITs. So it's a diversified portfolio of assets that historically have done well in these types of tail risk. I'm skeptical for lots of reasons about cryptocurrencies and Bitcoin, because they're not currencies. They're not a unit of account. They're not a scalable means of payment. They're not a stable store of value. And if you want wealth preservation rather than high volatility, you want to stay away from those types of assets.
Not a fan of Bitcoin. Nouriel Roubini of Roubini Macro Associates talking to Bloomberg's Eric Balchunas. Coming up, it is Thanksgiving, which means tomorrow is going to be Black Friday, and retailers are bracing themselves for potential records. We'll talk about that next. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Keely Lyons deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
So, Turkey today, shopping tomorrow. Black Friday is almost upon us. Retailers are certainly gearing up for what could be one of the biggest Black Fridays ever. We've seen the consumer data recently, very, very strong. Let's talk more about this with Andrea Felstead. How big is it going to be? How potentially could this be? The data on the consumer out of the States at the moment is super strong.
I think it's going to be a big Black Friday, and some reasons for that are good and some reasons are not so good. So,
start with the good.
Yeah, so the good. I think retailers have been quite, they've actually been quite restrained in their discounting last year. Last Black Friday, they were quite restrained. That discipline has continued this year. So the consumer knows if it wants deals, they're going to hunt for them and they're going to wait for them. Yep. And so that could see where there are deals responding. The bad is, you know, the low-end consumer is still under pressure. We had Target say last week that consumers were being resourceful. We know the consumer's been picky. It's only buying, you know, what they need. But they said there was this new element at play which they described as resourceful, where consumers have been waiting for deals. When they're on deals, they stock up. When the deals are over, they don't buy as much. So they had a really good, like, what they call their circle sales week in October. But they had a dip before and a dip after. So I think those two together, we could see quite a big Black Friday.
So, but there is a tension here between a consumer that is looking for deals and a retailer that doesn't want to give them.
Exactly, yeah, and it's really who blinks first. It's always who blinks first. Now, the one area I think there could be savings in Europe and the US. We had quite a warm autumn. Europe was good in September, very warm in October. The US was warm late October, November. So if you're in the market for a coat, sweater, boots, gloves, then you could see some good deals on those. Yeah. But I think they are really trying to rein the deals in.
But if it stays warm, why do I need those anyway? I guess is the question. I always feel I need to ask you a sequence question around the holidays. You always tell me that people buy too many sequins. Is that going to be the story again?
It's always the same. They always go too much.
Sequins are always on sale, basically.
Yeah, there's always too many sequins, I feel. And I think we're particularly at risk, and we were last year, we are this year. I wonder if people will rein in going out a little bit. You know, we've had a few Christmases where we could go out, no lockdowns. The consumer is still under pressure. When you look in the US, food prices in the supermarket have stabilised, but eating out of home, the prices are still going up. Right. In Europe, we've still got the lingering cost of living crisis here, and I wonder if that is a way that people will dial back going out. Home. Not necessarily. You dress up. You might buy a sequin T-shirt. You might buy a sequin skirt. But you won't buy the head-to-toe sequins.
Okay, so we've got sequin advice out of the way. In terms of how important the US is, though, particularly for European brands, How significant is this moment going to be? Because the rest of the world feels really depressed at the moment.
It is. I think the US consumer is coming back. You talk to the luxury brands; they're pointing to a bit of resilience in the US. It's not, it's not racing away, but it has stabilised, and they are hoping with China.
Yep.
Still in the doldrums, that the US will pick up some of the such things like watches, luxury bags. That they're really looking to the US for growth.
You've also got a stock market that's at near record highs. You've got Bitcoin that has been tracking towards 100. I know it didn't make it. We're back at 95. How significant are those factors when we think about what spending is going to look like?
Luxury tends to correlate with the stock market, so that's a good sign. Now, what we saw last time when we had the boom in the US, sort of 2020 to say 2023, Bitcoin and crypto was a big part of that. That fueled things like the watch buying, that fueled the bubble in the second-hand watches. Now, we haven't seen that yet. Watches are stable. We haven't seen a recovery. That will be something to watch for, and I think watch the secondary market, because that tends to be a bit of an indicator of that. I do wonder whether people will be quite as eager to funnel their Bitcoin gains into things like that. But it definitely correlated last time round, and there's a good chance it will this time too.
Is there going to be any sort of... We're already starting to hear of industries stocking up in advance of Trump tariffs.
Yeah.
Luxury looks like it could be very much once again in the crosshairs of the Trump administration. Is there an element of that we should also watch out for?
Definitely. Just from the US results this week, we have had the companies talk about tariffs coming in. Obviously, the luxury brands make more in Europe, obviously, rather than China. So they will be affected by the European tariffs rather than the very high Chinese tariffs. But it's still another headwind they've got to deal with.
And are companies that haven't raised prices aggressively going to do better, therefore, in that kind of environment?
Yes, but they've all raised prices. There are very few that haven't raised prices. Typically, in a typical market, luxury would be more protected because it could raise prices.
But the price rises have been epic recently.
They have been unbelievable, yes. They really have, and they really have gone too far, and that is why the consumer is pushing back. We are seeing some changes. Some people are reining in prices. Very few people lower their prices in luxury. Yeah. What we will see is the introduction of lower price products, so smaller bags. So a lot of mini bags everywhere. That's because a mini bag you can legitimately charge less.
I'd like a mini driver, but that's a golf thing rather than a mini bag thing. Andrea, nice to see you. Thank you very much indeed. Andrea Felstead walking us through what we should expect tomorrow when the Americans are done with their turkey and turn their attention to what is happening with the shopping story. Coming up, Jeff Yu of BNY is going to be joining us as well. Jane Kinnaman of the European Leadership Network is also going to be joining us within the next hour. At the moment, European equities are broadly higher. The Stoxx 50 up by 0.7%. We are also watching out for a CAC 40, which is actually a little bit higher as well, which is interesting given some of the politics that we are seeing around all of this. The FTSE 100 a little bit more muted. US futures at the moment are pointing to a negative start when trading restarts, but I don't think we're going to see proper and full trading until the end of the week. Anyway, that wraps things up. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to Bloomberg Markets. I'm Tom McKenzie in London. Your top stories today. France's 10-year yields match Greece for the first time ever on rising concerns about stagflation and political uncertainty. US regulators turn their focus on Microsoft with a wide-ranging investigation into its offerings from AI to cloud computing. And Lebanon's economy minister says the truce with Israel is an opportunity for peace. Part of our interview coming up. Let's check in on the markets. Happy Thanksgiving to everyone, of course, who celebrates. US markets, of course, closed for that holiday. Futures, though, are pointing to some modest gains when it comes to the reopen of US equity markets on Friday. Currently, European futures gaining 0.4%. S&P futures then up 8 basis points, 8 points. Nasdaq 100 futures looking to add 0.2%. Let's flip the board and look cross-asset then. We have, of course, the political challenges in France in focus with question marks around the budget yields actually edging slightly lower when it comes to French debt, and you can see that on the benchmark 10-year. Still above that 3% level, though, but not by much. Clearly near that parity level with Greek debt. We're going to break that story down for you in detail in the next minute or so. Euro-dollar, single currency at 105. A little softer by 0.1%. Brent up 0.8%. OPEC Plus pushing back their meeting, so we'll see what they decide in terms of those production cuts, whether they actually commit to those. Gold at 2,647 per troy ounce, the yellow metal gaining in the session 0.4%. To the story around France then. French assets under pressure as the country faces a deepening political crisis. A possible no-confidence vote threatens to oust the Prime Minister, causing uncertainty and fueling investor concerns. Let's get more on the political situation first now from Bloomberg's Caroline Connard, who joins us out of Paris. Caroline, how likely is this vote on pension reform repeal today? To what extent is the likelihood that that is going to pass? What do we know about the concerns around the budget?
So what's interesting, Tom, about this vote today is not that it's going to pass, because it's going to be blocked in the Senate. What's interesting on this pension repeal vote today is that the National Rally and the left wing are probably going to join forces on a subject that is against the Barnier government, which obviously doesn't bode very well if the Prime Minister faces a vote of no confidence in the next few days. So technically, today is kind of first step, and then next week we're going to have a vote probably on the security, the social security part of the budget, and that's when Michel Barnier will probably face his first vote of no confidence. You saw the quote from Antoine Armand, the French finance minister, here this morning on radio, trying to reassure the markets, trying to say we're going to make some concessions on the budget, because it's better to have a budget with concession rather than no government at all in another political crisis and chaos in France, like we've seen during the snap elections last July.
Yeah, indeed. And Caroline, when it comes to what we've heard from Marine Le Pen, a key player, of course, in the decision-making as to whether or not this vote of no confidence or vote of confidence is and ends up in a collapsed government. What are we hearing from the far-right politicians in terms of whether or not they are going to support this French Prime Minister at this time?
Marine Le Pen knows very well that she has all the cards in her hand. She is the kingmaker in parliament since those snap elections, because if she does support anything from the left wing, then the Barnier government will collapse. And in fact, the panic we've seen on the markets over the past couple of days, whether it's the pressure on the bank stocks, whether it's the bond market with this French borrowing cost actually reaching the levels of Greece earlier this morning, all this has been due to this pressure from the National Rally, from Marine Le Pen over the past few days, threatening to support a vote of no confidence. She has repeatedly said that she's got some red lines on the budget. She doesn't want to see prices of medicine rise. She doesn't want to see new taxes on electricity. And she doesn't want any delay on the indexation of pensions on inflation. Here's what she had to say over the past couple of days on this.
If the budget stays the same, yes, this is not a surprise. We always said it for the past 3 months. I'm telling you, if this budget is not approved, the budget of last year will apply, and actually it's not as bad as this one, as there are less taxes for the working and middle classes.
We'll see if those promises of concessions from the finance minister this morning actually are enough to reassure the markets. But it's really a game of chicken with Marine Le Pen. We'll see next week if there is actually a vote of no confidence. We'll see if the investors are reassured. Some analysts are saying the spread between the French and the German 10-year yield could actually raise to 100 basis points if there is another government collapse before Christmas. And Tom, I want to finish on a Thanksgiving quote with this minister from Macron's government, Marc Fesneau, who is actually in charge of the relationships with the parliament. He was saying, "We are like turkeys waiting for Christmas."
Okay, Karen Connor, thank you very much indeed. With the reach there for an analogy around Thanksgiving. With the politics of France continuing to be in focus for these markets, the yield down slightly, just 1 basis point on the benchmark 10-year French government debt. The OATs, of course, OAT is currently at 3% as what's been yielded. Euro a little softer in the session. Let's bring in Jeffrey Yu at this point, BNY senior strategist for EMEA markets. Jeff, thanks for your time this Thursday morning. Let's start with a question of France then, and how much is priced in when it comes to the euro around the political risks of France at this point?
I think the burden is more on the OAT yield and spreads right now. In terms of the euro, it's more about the ECB. How will the ECB respond to this? We've got CPI figures coming through today. I think they're just going to keep an eye on things. But from the euro's point of view, it's about how much dollars there are to sell for the market. There's been quite a bit of buying over the last month. And then we'll see where rate expectations go. So I'll differentiate what the euro is doing versus what the bond market is doing. But looking at our client flow data, the last week was one of the worst on record over the last 10 years or so. It's actually the 8th worst week on record and one of the worst weeks since the energy crisis 2 years ago.
Okay, one of the worst weeks on record. Are you getting a sense at all, Jeff, in terms of conversations with the clients, that there may be a buying opportunity when it comes to French assets, or are you still a long way from that?
I think you're heading into month end and even heading into year end. It's not really a buying opportunity for any asset at this point. It's more about rebalancing. It's about managing asset allocation. And there are quite a few permutations with regard to French elections and European politics up ahead. So they're not really taking a view on it right now. Speaking to clients, I think they're much more concerned about volatility in terms of where the ECB is headed. We had some comments from Schnabel this week, for example. Sounded like rates were going up, not down. So that's another thing to consider. But clearly Q1 next year, politics in the Eurozone, especially given new elections in Germany, that's going to be a feature for asset allocation.
Well, talk to us. What is your updated view then, Jeff, given what we heard from Schnabel, given the slightly softer inflation data out of Spain today? What is your current assessment of the cycle going forward into 2025 for this ECB?
No change in our view. We still think euro-dollar is heading down to parity. I was expecting it this year, so it's come a bit late. So we'll probably roll that into Q1 or maybe early Q2, subject to how the tariffs go from the US and also politics, of course. ECB need to look at what are the Swiss and the Swedes. What is the ECB seeing? Well, not seeing that the SNB and the Riksbank are seeing, where they're going very aggressively. They're heading towards neutral rates. Heading towards towards the zero lower bound in Switzerland's case. Surely, these two economies, they're very exposed to the European supply chain. They're much more concerned about the direction of travel on a structural level. Look at the PMIs, worried about services as well, even though input costs are still high. So that cycle, that structural issues facing the Eurozone, that is not going to change. And I think the ECB is picking up on that. Hence, euro-dollar still lower.
Does an ECB picking up on that, Jeff, signal that a 50 basis point cut could be in the cards for them, a jumbo cut in December?
We've had probably about 15 to 20 speeches already this week. No one has ruled that out. They're quite coy about this right now. I think everything is on the table. I think the market would be right to price in something along the lines of 40 basis points, give or take. It must be on the table. And if we want to extend that out to some extent, any meeting between the December meeting and the March meeting, where the next set of forecasts will come out as well, a 50 basis point move at any of these meetings should not be ruled out.
Okay, do not rule out jumbo cuts from the ECB. Expectations, of course, from the markets that we'll get to below 2% by the second half of next year. And you still see euro-dollar parity. Jeff, when it comes to the pricing around potential tariffs from this incoming President Trump and his administration, a pretty fascinating decision from the BOK, the Bank of Korea, earlier today to kind of do a preemptive cut and talking specifically about the risks of incoming US President Trump and tariff threats. Is that a signal to other central banks, or is that an idiosyncratic move by the Bank of Korea?
I think it will always be idiosyncratic on a country-by-country basis in terms of how you react to this. But I do hope that all the export-oriented economies, be it in Asia, and I'd even add Eurozone or Switzerland to that extent, if you're worried about tariffs, focus your savings more on the domestic side of things. Focus more on consumption. Aim for domestic reflation. That's something, especially Asia, really needs to turn its head around. So that requires coordinated policies between the central bank, between finance ministries. It's something that actually China, I think, is looking at a bit more. If anything, markets were pricing that in towards November or December. We're seeing it in some of our flow data as well. So for other economies, exporters in the region, Korea, Japan included, they really need to revisit their strategies as well. Japan looking at another stimulus too.
Yeah, well, on Japan then, Jeff, what does that stimulus package mean for the yen? That it seems that there's an increasing probability being priced in the markets that you do get potentially another hike from the Bank of Japan in December as well. Does the gap that we see still in terms of that rate differential continue to be a theme in terms of yen weakness in 2025, or do you see a gap that closes and puts support under that currency?
It really needs to start supporting the yen right now. And if we do get escape velocity on reflation via fiscal stimulus, and I hope, again, this fiscal stimulus is more directed towards the household, the Asian household really needs support there, then I think that will open up more room for the BOJ to move higher on rates as well. So turn this into an opportunity. I think that really is the message for the exporters, running these surpluses and plowing it back into treasuries with concerns over the US deficit up ahead as well, and notwithstanding rates could fall over the medium to longer term in the US. Really, a change of strategy is needed. So I would say which country can get the balance of reflation, especially fiscally driven reflation, right, utilize the surpluses channel it towards domestic households. That's where you will see real effective exchange rate appreciation within their currencies, and I think the yen could be at the forefront of that.
Really interesting. Let's see if policymakers are listening in, Jeff. That reflation case being made there by Jeff Yu of BNY. As we look at euro-dollar, currently at 105, a little softer by 1/10%, with Jeff signaling maybe in the first quarter of next year you get to parity with the euro versus the US dollar. The Japanese yen also weaker in the session by 0.4% at 151.78. Let's bring you some breaking news right now on the corporate front. The drugs maker, Spanish drug maker Grifols, of course, the business. Bit of disappointment earlier in this week when Brookfield Asset Management dropped its plans to acquire Grifols. It is, of course, contending with a pretty significant debt pile of around 9.2 billion euros. And the line's coming through in terms of the CEO saying that the company is in talks to refinance that debt and that credit line as well. They're in talks with banks to refinance 1.4 billion euros in bonds due next year and extend a revolving credit line. The company CEO says plan A is to refinance the bonds, and they're also considering repaying them with cash flow. So that is some detail coming through from Grifols with a debt pile of 9.2 billion euros after Brookfield walked away from a potential takeover of that Spanish drug maker. Coming up, US Federal Trade Commission zeroes in on Microsoft with a wide-ranging investigation. We have the details of our Bloomberg scoop, the scrutiny on Microsoft. That's coming up. This is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Earnings season is here.
Third quarter earnings season, as we've been talking about, really in high gear.
Bloomberg is first to break the numbers.
We have some big earnings after the bell. Earnings from Caesars crossing the Bloomberg terminal.
Mondelez is reporting
Reddit, AMD, Snap.
Let's keep the conversation going.
With the smartest insights.
The bar keeps getting higher. 20% growth rate, when your comps get tougher, how much can you beat and raise?
Continuing coverage on Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets. I'm Tom McKenzie in London. Now, the US FTC is investigating Microsoft. We're told the Federal Trade Commission is looking into everything from the company's cloud computing and software licensing businesses to cybersecurity offerings and AI products. Let's get the details then on this Bloomberg scoop and bring in Bloomberg's Peter Elstrom. Peter, what do you know about the scope of this investigation and where the FTC is in this process?
So the Biden administration is trying to finish up a few things in their last week in office here. And one of the things that we're seeing out of the FTC is that Lina Khan, who leads the commission, is launching a couple of these antitrust investigations. She's been very aggressive in going after some of the big tech companies, Google in addition to Microsoft. Now we're seeing this focus on Microsoft. And again, this is a Bloomberg exclusive. This is not publicly announced. Our reporters have found out that they've spent about a year talking with partners of Microsoft, some of their customers also, to find out exactly how Microsoft is bundling some of these products that you mentioned, including cloud computing, their cybersecurity services, their AI services, and there's some concerns that they're using their market power to be able to keep out some of the competition in this area. One of the things that triggered this also is that because Microsoft has such a strong presence in cybersecurity and because the federal government is a big customer, they're concerned about some of the vulnerabilities around those services that the government gets from the company.
Yeah, so there's a national security element to this because, of course, they sell a lot of their software into the Defense Department.
That's it, exactly. And we had a pretty big breach, a pretty big issue with cybersecurity software in the past that affected a bunch of the Microsoft computers. That sort of raise the urgency of some of these issues that they're looking into. Now, of course, we're only weeks away from a new administration. The Trump administration is going to take over. That could have some very dramatic changes for these kinds of investigations. Lina Khan certainly is going to leave after this, and somebody else is going to take over the FTC. I think generally there's an impression that the Republican administration is going to be a little bit lighter on some of these big tech companies, but there have been signs that they're not too happy with big tech. J.D. Vance, in particular, the vice president, has spoken out against some of the power of these big tech companies. So we have to see where they're going to go with these sorts of investigations.
Yeah, so we don't really have a clear steer, do we, on what the incoming Trump administration, what line they're going to take on some of these investigations.
Yeah, that's exactly right. We know that the FTC is not going to be led by Lina Khan. She is not going to be able to see this one through. But this investigation has gone pretty far along the road. We know it's pretty broad. We know they've gathered a lot of information, and now they're seeking additional information from Microsoft itself. So there will be some foundation for them to begin with as they begin the next administration.
And we can expect, presumably, that Microsoft will put up a legal challenge.
Of course. They did that last time. It was more than 20 years ago. They were under antitrust investigation. They fought back very hard. They ended up winning that on appeal as the administration just changed. We do think there's a much tougher stance for some of these big tech companies. We're also seeing Google, of course, under scrutiny, and there's some pressure for them to separate the Chrome browser. So we have a lot of these investigations in motion at this point. We have to see where they're going to go from here.
Peter Elstrom, excellent. Thank you very much indeed on the context around this Bloomberg scoop, leading our tech coverage in the region. Thank you. Meanwhile, shares of Chinese driverless tech firm Pony AI fell in US trading, its US trading debut after an early pop. We spoke with the CEO and co-founder, James Peng, about their growth strategy amid rising tech and trade tensions between Washington and Beijing.
In terms of the sanctions on the chips, actually for us, it's nothing new. We have dealt with this for quite some time already. So for our strategy was and remains to be that we will diversify our supply chain. And I think as the more and more manufacturings of the chips coming out from either in China or rest of the world, we'll try to have more diversified supply chain to further de-risk our exposure to the geopolitical tensions.
Hi, James. This is Steve Engel here. We met, I believe, at the Beijing Auto Show earlier this year. And I did take a ride in one of your LiDAR and Pony AI-equipped Toyota robocabs in Beijing. I do understand that, you're a company that had some robo trials in the Bay Area, but also in multiple cities in China. So you kind of have, influence in both the United States and China, obviously. But what was the main questions as you took your company public in New York? What was the main concerns, if you will, of potential investors when you went on that roadshow in the United States with increased geopolitical tensions?
Surprising, actually, the geopolitical tension questions wasn't at the front and center of the investors, but rather the investors more focused on the economical side of the robotaxi. People are really interested in figuring out when will be a time for the robotaxi to be actually large-scaled, deployed, and be profitable. So I think the good news is that people really believing that 0 to 1 has already finished, and now it's the time for the autonomous driving companies to really go to the large-scale commercialization.
What does that look like exactly, James? Because right now you're operational in 4 of the top or tier 1 cities, but what does that actually look like, say, over the coming 1 to 2 years? I know that you're going to continue to focus your efforts primarily in China, but talk to us about the competitive pressures that you face there as well.
Yes, our especially if you're talking about the next 2 years, our main focus will be on the tier 1 cities of China, and actually just this year we also signed a deal with Beijing Auto and Guangzhou Auto to mass produce autonomous driving vehicles. So that means in the next 2 years, we'll have at least 3 models coming out of the assembly line will be launched into the tier 1 cities in China. So I think with the support of further support of the regulations, and the residents actually get more familiar with our services, I think we will have a much larger fleet, have a bigger coverage, and hopefully we'll be able to actually have a much larger scale commercialization.
Okay, that was James Peng, co-founder and CEO of Pony AI, speaking to Bloomberg's The China Show. We are going to check in on your markets right now. With European markets, the benchmark stock 600 currently up 0.4%. In terms of the breakdown, sector by sector, technology, top of the list, gaining 1.6%. A little bit of relief trickling through on expectations that maybe the next round of restrictions by the US, by the Biden administration on exports of chip technology to China, maybe some of those restrictions will not be as onerous as some had expected. So tech as a sector getting a lift, currently up 1.6%. At the bottom of the list, though, real estate taking a hit, down 0.3%. Chemicals also off by 0.3. In terms of your individual indexes, the UK FTSE 100 currently flat at 8,276. S&P E-minis, as you can see, futures in the US, when markets reopen after the Thanksgiving holiday, they will reopen for a partial day of trading on Friday. US futures pointing to gains of 0.1% after some losses yesterday. US futures closed in the red on Wednesday. Nasdaq 100 futures pointing to gains of 0.2%. In the currency space, euro dollar softer by 0.1% at 105. Continue to scrutinise moves, of course, in the French debt markets, with your French benchmark 10-year currently yielding you 3%, almost in line with the equivalent in Greece. And a reminder of the market concern about the politics of France and the ability or lack of ability for the Prime Minister to push through that budget later this year. Brent trading at 73.49, up 0.9%. So prices are up in oil. The Middle East, of course, continue to be in focus with the ceasefire continuing, at least seemingly, to hold between Hezbollah and Israel. Yellow metal, gold at 2,646, up 0.4% so far in the session. Coming up, talking of the Middle East, we're going to be getting perspective with Jane Kinnemont of the European Leadership Network. We'll talk about that region and the impact as well of the Trump administration on those conflicts globally. Stay with us for that analysis. This is Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Welcome back to Bloomberg Markets. I'm Tom McKenzie in London. Now to the Middle East, where residents of southern Lebanon are returning after a 60-day ceasefire between Israel and Hezbollah takes hold. Lebanon's economy and trade minister, Armin Salam, sees this as, quote, an opportunity for peace. He spoke with Bloomberg's Jemana Besetchi earlier.
I call this an opportunity. It's more of an opportunity. It's not a celebration. It's not a win. It's an opportunity for Lebanon today to really seize it, to save the country from further devastation, from further escalation into this war that Lebanon has paid a very, very heavy price for. So I see this as a very good opportunity, backed up by big countries like the United States, like the European Union, like other major players from the Arab world, including Saudi Arabia, Qatar, Egypt. So we should seize this opportunity and save Lebanon. It's an opportunity that might not come back if we don't know how to handle it.
Yeah, absolutely. And not just handle it, but also make sure that it is implemented properly. Because if you look at the terms of the truce, they mirror very much that UN Resolution 1701 that was put in place after the 2006 war. The issue with that is that it was never fully implemented. What guarantees do we have this time around that Hezbollah are going to adhere to the terms of the truce?
Well, times have changed. Since 2006 and 2024, things have changed. There's a big shift in the region. There's a big shift in Lebanon. We, as a government, and Hezbollah as part of this government, have felt, at least for the past few months, that there is a complete change in the tonality of Hezbollah's approach to the next stage in Lebanon, to the next Lebanon that we dream of. Because, as you know, probably Lebanon for the past 75 years has paid a very heavy price for the Israeli-Arab struggle. And we have never witnessed really a serious sovereignty for the government, for the Lebanese military, all over the Lebanese territory. I think it's about time everybody realizes, including Hezbollah, that we cannot keep running away from this. If this country is to be backed up, if this economy is to be supported, and if the damage is to be rebuilt, we will need to adhere to all the international laws, to 1701, and we need to become a fully sovereign state with a president, most importantly elect the president, for the international community to take this country seriously and trust that they can support it to get out of this dark tunnel.
Okay, Lebanon's economy and trade minister speaking to our Middle East anchor, Jemana Besetchi, earlier today. Let's bring in at this point Dan Williams joining us from on the ground in Israel. Dan, give us a sense of what is happening on the ground. We're seeing a return of residents in Lebanon to southern parts of that country. Are we seeing a similar picture when it comes to northern Israel? What is the mood on the ground in Israel, in the north of the country, around this ceasefire, and expectations as to whether or not it will hold?
I think there's some optimism. It's extremely cautious. It's quite wary. It's worth noting that despite the welcome messaging we heard there from the central government of Lebanon, the intention of that central government to apply to institute its authority throughout the south, it would appear that the deployment of the Lebanese military has been outpaced by the return of Lebanese and apparently